Hello, everyone, and a very good morning. First of all, let me convey my regret due to internet issues. We were unable to start our webinar on time. I'm extremely sorry for the inconvenience. Distinguished delegates, presenters, and participants from SARC member states and other regions around the globe. It gives me a great pleasure to extend you all a very warm welcome on behalf of SARC Energy Center. I'm very thankful to all of you for joining us in the webinar to disseminate a study on mobilizing international and regional funding for implementation of renewable energy projects within SARC member states. My name is Ehsanullah Marwat, and I'm working at SARC Energy Center as Research Fellow Energy Efficiency. I shall be moderating today's webinar. Ladies and gentlemen, SARC Energy Center conducted a study to highlight issues and suggest way forward for mobilizing international and regional finances for implementation of renewable energy projects in the region. The study explored ways to seek support for implementation of renewable energy projects and measures for speedy mobilization of financing from private sector. In order to disseminate the findings of the study and to get feedback from member states for value addition, SEC is organizing this dissemination webinar. In today's webinar, we will discuss overview of renewable energy landscape in SARC, key financial instruments for renewable energy financing, key findings and recommendations, and last but not least, financial incentives and mechanism to encourage private sector investment. I'm extremely grateful to our elite panel of presenters, such as Mr. Rahul Raizada, who is Director Power and Utilities Practice at PricewaterhouseCoopers Private Limited, India, Mr. Ankit Vivek, an Associate Director Corporate Finance and Investment Banking with PwC India, Mr. Sandeep Kumar Mohante, who is Director Energy and Power with PwC India, and Mr. Amir Zafar Durrani, who is President and sole proprietor of Re-Energia Pakistan, for their enthusiasm and eager willingness to participate in this webinar. I shall be introducing them in detail before the start of their relevant sessions. Dear participants, you will have the opportunity to ask questions to presenters by typing your questions or clicking to the raised hand option in the attendees pane of the main window of GoToWebinar software. You may send in your questions at any time during the presentation. We will collect these and address them during question and answer session and at the end of each presentation. Ladies and gentlemen, it is my pleasure to inform you that the Director SARC Energy Center, Mr. Muhammad Naeem Malik, has also joined us in this webinar. We are very thankful to you, sir, for taking out time from your busy schedule to attend this event. So I may request Mr. Muhammad Naeem Malik, Director of SARC Energy Center, to deliver his welcome remarks.
Thank you. Thank you, Hassan. Thank you very much. Dear participants, presenters of the webinar, friends, and my colleagues. Assalamu alaikum and very good morning. I, on behalf of SARC Energy Center, welcome you all to this dissemination webinar on mobilizing international and regional finances for implementation of renewable energy projects in SARC member states. It's a great honor for me to open the discussion on this important technical topic for development and prosperity of over 2 billion people of this region. Dear participants, the SARC Energy Center is a regional institute on energy and a technical arm for SARC organization on energy matters. It is our endeavor to translate the energy vision of SARC leaders into reality. Dear participants, the center started its operation in the year 2008. During last 10 years, the center has emerged as a vibrant and effective SARC institute, which has played its role and vital role in all regional level energy initiatives. Until 31st December 2019, the center has carried out more than 120 interventions. The reports are available on our website and may be uploaded. Dear participants, hydrocarbon reserves in the South Asia are limited and are declining. All SAARC member states are net importer of hydrocarbon to improve energy security, increase energy access, and reduce carbon emissions. SAARC countries are striving their best to expand share of renewable energy in their overall energy mix. International and regional financing and funding is needed to make significant investment in renewable energy technologies. We also need to address the barriers and risks that presently hold back private investment. Dear participants, keeping in view the important role of financing in developing renewable energies and technologies, SAARC Energy Center conducted a comprehensive study on mobilizing international and regional finances for implementation of renewable energy projects in the SAARC member states. The study helps to identify difficulties and suggest measures to attract and generate finances for development of renewable energy projects in the SAARC region. It concludes that in South Asia, regional and international funding can help in energy security, decrease in import bill on fossil fuels, and usage of environment-friendly technologies. Dear participants, in this webinar, we have invited experts from SAARC region. I am delighted to acknowledge the great cooperation and support extended by them. In the end, I once again thank you all for joining this webinar and shall request you to kindly feel free in expressing their views and opinions during the webinar. I would like to extend my special thanks to the presenters of the webinar as well as PricewaterhouseCoopers Private Limited, Mr. Amar Durrani, and all those who participated and contributed in the last study. Lastly, I wish you all a very comfortable learning and knowledge sharing session. With these words, I declare the session open. I request now Mr. Asarullah Baba to take us through the agenda. Thank you. Thank you very much.
Thank you very much, sir. Thank you, Director SAARC Energy Center, for your visionary thoughts and high plans for the region. Well, ladies and gentlemen, let's move to the technical session and start with formal presentations. Our first presenter is Mr. Rahul Raizada from PricewaterhouseCoopers India. Rahul is Director of Power and Utilities Practice at PricewaterhouseCoopers Private Limited, India. He has an experience of more than 14 years in advising clients. Rahul brings hands-on experience of advising state governments, utilities, multilateral and private enterprises in the area of distribution reforms, promotion of renewable energy and PPPs. He has worked across countries such as Nepal, Cambodia, China, Vietnam and Ghana. He has a master's degree in management and is a graduate in computer science engineering. So over to you, Mr. Rahul Raizada. Mr. Rahul, are you with us? Mr. Rahul, can you hear us?
Hello.
Yeah,
Yes.
yeah.
Am I audible?
Yes. Yeah, you are very clear.
Okay.
Please go ahead. Thank you.
Thank you. Thank you for the introduction and a very warm good morning to all the participants. The presentation I'm going to make today is around overview of renewable energy in the SAARC region. I plan to cover what is the status of renewable energy in terms of installed capacity, in terms of penetration. What is the institutional framework which supports the promotion of renewable energy in these SAARC nations? Finally, I will also touch upon what are the barriers which are inhibiting promotion of renewable energy in the SAARC nations, and what are the opportunities for primarily funding these projects, which can help SAARC nations come up with newer projects as well as newer technologies which can be deployed. So if we look at the need for renewable energy, uh, I would try to put focus on two areas. One is the access. The SAARC nations have done extremely well when it comes to providing access to electricity to its population. And if you look at the comparators of 1990 to 2016, you will see most of the countries in the SAARC region have provided access to almost greater than 90% of its entire population. Still, there are gaps which remain in providing access. And this is where renewable energy can play a very prominent role. The second comparator I would like to focus on is the per capita consumption. If you look at average per capita consumption of SAARC region, it is close to around 700 to 800 kilowatt hour per annum. This is way below the world average of close to 2600 or OECD countries who are more than 10,000. But as the quality of life improves and as the penetration of energy improves further, the commercial activities are also going to pick up, and therefore the requirement of energy is also going to increase, which essentially means we will be looking for more energy, more sources, and with depletion in the hydrocarbons, particularly coal and other fuels, renewable energy provides a promising solution to overcome this issue regarding to providing cleaner fuel for the population. When it comes to, while at one hand we are saying renewable energy is a good solution, uh, the second question really arises: is there enough potential to install renewable energy in the SAARC region? And the
Mr.
answer
Ram,
is
Mr.
yes.
Ram, I am Naeem Malik. May I request you to go to your previous slide?
Yeah.
All right. What is source of information which you have used here in this slide? Like you have said that population access to electricity in terms of percentage, Maldives is 100%, Afghanistan is 84.1% in 2016. So what is the source of this data?
So this is all coming from World Bank survey reports, and we have used, because we have to compare it across all the nations in one single year. So we have used a common comparator which is available for all the 8 countries.
And this information has been taken from the World Bank document?
Yes, yes.
Okay, please. Now you can move to the next slide. Thank you.
So as I said, if it when it comes to providing renewable energy, the question is there enough renewable energy available in the SAARC nations? And the answer is yes. And if you look at various potentials of whether it comes to solar power, hydropower, and wind power, there's enough potential in all the countries of the SAARC region. In fact, Bhutan and Nepal are saddled with hydropower potential. Similarly, Pakistan. Solar power is hugely available in terms of the barren land masses which are available in Afghanistan, India, Pakistan. Sri Lanka has because of its large coastline, it has a huge wind power potential. Maldives being a small country, but it still can harbor solar power and wind power. If you look at what is the current status of the installed capacity and peak demand, if most of the countries, particularly if it is driven largely by India because of its sheer size. It, India has an installed capacity of close to 160, 330 gigawatt, whereas all the if we combine all of the installed capacity in the region, it comes close to 400 gigawatt. So almost 80% of the installed capacity is coming from India itself. Peak demand too is significantly higher in case of India when compared to other countries. However, if you look at how much peak demand has been met, most of the countries have met them, apart from Nepal, apart from Maldives, which is slightly greater. Most of the countries have been able to meet their peak demand.
Mr. Rahul, very sorry for interruption
Yeah.
again. You have shown that India's installed capacity is 330,000 plus, whereas the peak demand is 164,000. Yeah, are you saying that the installed capacity is around 2.5 times more than the peak demand?
Yes, that's correct. Because this
So
also includes close.
where that surplus capacity is right now going, are you paying? India is paying uh, capacity charges for that installed capacity, which has been installed there because
That
of
is
demand.
true.
Mhm. Yes,
In
please.
fact, if you yeah, in fact, if you look at the breakup of this 330, close to, and my subsequent slide has that, around 80,000 megawatt is from renewable energy, which has a plant load factor of 20%, for which you have to pay the entire fixed charges. There is a hydro capacity of close to 60,000, where the plant availability factor is close to 35 to 40%. Again, you have to pay fixed charges. The rest is coming from thermal and gas-based generation, where there are two charges, which is fixed charges and variable charges. The variable charges are only payable when the plant is running. So yes, to cover the investment, it is mandatory for a person who is procuring power from a renewable energy or a hydro power plant to pay the cost of its, particularly the fixed charges.
Okay, thank you.
Does that answer your question?
Yes, Rahul, please go ahead. Thank you very much.
So if you look at the breakup of the entire, as I was mentioning, that in India, close to 66% is coal and gas, 14% is hydro, 18% is renewable energy. Bhutan is completely saddled with hydro resources, and therefore 100% of its energy generation is through hydro sources. Bangladesh, almost more than 90% is thermal power, and the rest is again thermal power, which is being imported from India. Maldives, it's 100% oil-based economy, and there have been very few small solar power projects which are now coming up in that country. Nepal, almost 91% hydro because of the potential of hydropower the country has. It also have a very few and small thermal power projects. Pakistan, 65% thermal power, including which includes gas, and 29% hydro. The renewable only contribute close to 3% of the entire energy mix. Sri Lanka has a very good mix of thermal hydel, 50 to 34, and rest coming from 14% from renewable energy. Afghanistan is largely dependent on imports and almost 77%. And we all know what are the reasons in a war-torn country. It can't have its own power plants to supply its populations, and therefore it has been importing most of the power from its neighboring countries. Now, this is a blow up of the component of the renewable energy installations in all the countries. So, if you look at, I'll start from Bhutan, which has solely hydropower, which is close to 11,000 megawatt. Bangladesh has only 230 megawatt of hydropower. India, solar of 21,000, wind of 34,000, biogas of 9,500, and hydro of close to 4,600. Maldives has a very, very insignificant component of solar and wind, and contribution to the entire energy mix is less than 3%. Nepal, just like Bhutan, because it is saddled with hydro resources, has close to 800 megawatt of hydropower, which is currently in operation. Pakistan has a huge component of hydropower, which is in its entire energy mix. The focus is now shifting towards solar and wind projects, and we see them coming up as we go ahead. And almost 31% of this energy component is from the renewable energy sources. Sri Lanka, again, hydro rich, and focus has been on this, but solar and wind sectors are now picking up in Sri Lanka. So after we looked at what is the potential and what is the installed capacity, I will here touch upon what is the institutional framework available in these SAARC nations to promote the renewable energy development in the respective countries. So if you look at the institutional structure, each country has started giving priority on the renewable energy setup, has set up institutional arrangements for promotion of renewable energy technology, and now they are putting in place policy framework which promotes the use of renewable energy technologies. So I'll take example of India, which is a dedicated Ministry of Renewable Energy. It has given targets to all the states to comply with the renewable purchase obligations. It has budgetary allocations for renewable energy. More importantly, the policy framework is robust for promotion and investment facilitation for renewable energy projects. In Bangladesh, the Ministry of Power and Energy and Mineral Resources is the ministry which looks after the renewable energy sources. There is a public financing institution, particularly named as Infrastructure Development Company Limited, which looks at funding of the renewable energy projects which are coming up in Bangladesh. In fact, if I would like to point here that there are only two countries in the SAARC region, Bangladesh and India, where there is a public financing institute available. Now, this is an important point to note because having a public financing institute helps in promotion of renewable energy as funding is easily available, as well as the financing instruments are also easily available to make the projects bankable. Regulatory bodies in certain states in Nepal which have been recently established, and they have actually come out with setting frameworks, which are for promotion of renewable energy in their respective countries. Um, if you move to the next slide, this again gives an overview of which ministry is responsible in which country. Is there a federal institute? What are the regulators which are responsible for regulating the renewable energy sources? And if there is a public financing um, agency which is available. So as I said, only India and Bangladesh currently have a public financing institute. It is currently non-existent in all of the other SAARC countries. If we look at what are the key programs which have been launched by the SAARC member countries, and how many of them have focused on promotion of the renewable energy technologies. So Afghanistan launched Afghanistan National Renewable Energy Policy, under which they are giving promotions to any projects which are being put up in the renewable energy technology. There is the country provides facilitation in terms of clearances, in terms of land, in terms of administrative approvals. Bangladesh has recently been focusing significantly on the solar irrigation pumps. As you would know, Bangladesh is a low-lying country which is frequently prone to flooding. Therefore, surface irrigation is very prominent in Bangladesh, particularly close to the coastal areas. However, in the regions which are a bit interior, solar irrigation pumps hold a huge promise to providing sustainable form of energy to the farmers in Bangladesh, and for which the central government has launched schemes to provide incentives for setting up these solar irrigation pumps. In Bhutan, the focus has primarily been on hydropower, and they have policies to attract foreign direct investments. They have an alternate renewable energy policy. Furthermore, for developing hydropower more in Bhutan, they have also developed a master plan through which the identification of sites as well as timelines have been identified for development of these hydropower plants. India, as I mentioned earlier, also it has set itself a target of achieving 175 gigawatt of renewable energy by 2022, and towards this, it has come out with numerous policy measures, be it in terms of renewable purchase obligation, be it in terms of solar missions. All of these policy framework are being put in place to achieve the target of 175 gigawatt by 2022. Maldives recently came out with a energy policy and strategy where the focus is primarily on the solar energy, because as well as the wind energy, given that Maldives has a coastline, there is a potential to have offshore wind farms close to the Maldives coastline. Nepal again came up with rural as well as renewable energy program with focus on hydropower and development of sites which have been recently identified. Pakistan also came out with a policy in 2006 which provides for promotion of renewable energy for power generation, and there is an incentive package which is also provided in the policy. Sri Lanka has a long-term generation expansion plan which focuses on having at least 30% of the power from through renewable energy sources by 2037. So if we look at, as I mentioned, the targets, Afghanistan is targeting close to 10% of energy mix by 2032. Bhutan having additional 10,000 megawatt of hydropower. Bangladesh 10% of energy mix through renewable energy and access to electricity for all. India, as I mentioned, 175 gigawatt of renewable energy by 2022. So these are the targets which have been kept by various countries in the region. For Nepal, the idea is to achieve 80% electrification through renewable energy sources. This is a very ambitious target. As I mentioned in my first slide, that access has improved significantly in most of the SAARC nations, and renewable energy has been a key component in providing this access. Nepal is aiming to have 80% electrification through renewable energy sources by 2050. Pakistan, in fact, has promised to invest close to 500 million USD in renewable energy projects by 2030. And Sri Lanka has set itself a very, very ambitious target of having 100% electricity through renewable energy. Sri Lanka, as we know, is saddled with large hydro sources as well as wind and some solar potential. Now, having touched upon what is the potential, what is the institutional framework and targets, I will now touch upon what are the barriers which are hindering the growth of renewable energy in these countries. So some of the reasons I have listed on this slide include access to finance. Most of the projects which are there in renewable energy require long-term funding on a project finance basis. And this is where most of the countries are not able to provide long-term financing to make renewable energy commercially viable for most of the population across the country. The project size itself is one of the barrier in terms of transaction costs which are required. For example, there is a generally transaction costs are lower for wind and geothermal, but can be greater for other technology like solar, like hybrid, like any other battery operated technology. The risk and the barriers which are facing off-grid projects also differ from those on the on-grid. The off-grid projects, while they are very helpful in providing last mile access, and they are also helpful in providing a population with a reliable source of energy, the challenge is ensuring commercial viability of such projects. And this, because it is a scattered and a small project, the cost can be more, which becomes a key barrier in promotion of the renewable energy. Then finally, there are definitely technical challenges in terms of availability of land, issue regarding to issues regarding to offtake of power, issues regarding to evacuation of power, which are there, which provide hindrances in promotion of renewable energy technologies. So these are some of the barriers which I have put in, but I'll only focus on three, which are very, very important. First one is the credit risk. The credit risk in terms of whether the buyer will fulfill its contractual obligation or not. This is one of the key risks which is looked at by any financer who is funding a renewable energy project. The second is key lack of instruments for investments. Most of the SARC nations are currently not having renewable energy focused funding instruments. And as I mentioned in my previous slides, there are only two countries where there is a dedicated financing institute which is focusing on providing renewable financing. Rest of the countries do not have that current. And third is limited availability of debt capital. So these are the three main barriers where which are basically in hindering the growth of renewable energy in the SARC region. These are other technical barriers which force developers to look at alternatives rather than go into the renewable energy sector. And this includes construction rates, operation risk, as well as other, including policy and regulatory risk. So if you look at what has been the investment in renewable energy sector over the years in the SARC region, in fact, close to 10 billion USD was invested by the SARC member state in 2016, which is almost more than double of 4 billion USD in 2013. And the strong growth has been through, apart from India, has been coming from Bangladesh, from Pakistan, and from Sri Lanka. I believe that with further reforms in place and policy measures being taken by several countries, the SARC nations are expected to attract more investments in the coming future. Now, if we will quickly look on what are the financing options which are available for any funding which is required for a project which is coming in this area. One is through public mode, which is essentially through multilateral agencies like World Bank, Asian Development Bank, and others who are focusing on promotion of renewable energy in the region. It, it is a very easy source of financing and as well as it becomes easier as all the key project contours are defined through these public funding agencies. The second mode is through the public private partnership. This could be through having partnership with a private sector player who brings in his capital, and there is a package which is provided by the government, be it in terms of land, be it in terms of capital, be it in terms of any subsidy. Now this PPP is another mode of financing which can help creation of infrastructure setup for the renewable energy projects. And the third mode is, which is a pure private play. There can be IPPs, which are independent power producers and purely private owned, which can come up, set up their projects. Now this depends on what is the maturity of the market, what is the status of private sector in a particular country, and what is the attractiveness a private sector will get while funding in the renewable energy sector. These are the three primary modes through which financing can be achieved in renewable energy sector. When we look at where each of the countries stand in terms of these financing aspect, Afghanistan is primarily through public funding mode of financing. The government has to take lead by formulating its own renewable energy policy and setting targets. There is much help available from international agencies, World Bank and other agencies, which can be leveraged by the country while promoting or while formulating a strategy for renewable energy. Bangladesh is in the PPP mode of financing. It is a mature market and it has a sizable population. There are several schemes which have been floated by Bangladesh, and it has been attracting a lot of interest from the private sector side. And this, once this PPP mode becomes sizable, Bangladesh can then think of moving to a pure private participation in renewable energy. Bhutan, again, a very small country, but having huge hydro resources, and it has been quite successful in doing PPP model for hydro projects. And the focus currently is to consolidate its position as far as PPP funding and attracting investments in the hydropower is concerned. India India uh, uh, has a very mature and a large market. There are several IPPs which exist in India. There are projects in PPP mode, and there are projects which are being established through funding from international agencies. From a maturity perspective, India is a mature market when it comes to investments being attracted from the private player. Maldives is purely dependent on public funding mode as it is a small island nation and currently also has limited resources for which can be tapped, and therefore it will be looking primarily to the government for developing this sector. Nepal, just like Bhutan, is a small but a fairly mature market, and it has been attracting a lot of interest from the private sector through PPP mode for developing in its hydro resources. Pakistan is a sizable market and its financial infrastructure is mature, and it can handle a lot of projects in the PPP funding mode. And this a policy and a government framework is what is currently lacking there, which can actually push a bit more to all the investors to come up with more projects, particularly in PPP mode. Sri Lanka, again, dependent on PPP funding. It has developed a very robust energy framework, and there are several initiatives which have been taken by the government to develop this sector. I believe having such a robust policy framework and other contours already in place, there will be a lot of interest from the private sector to come up with projects, particularly in PPP mode. That's all I had in my presentation. I will be happy to take any questions anyone would have on this.
Rahul, Rahul, are you with us?
Yes, I can hear you.
Rahul, first of all, thank you very much for your presentation, sparing your time and for being with us today. My question is that every type of financer, may it be in the public sector or private sector, will finance any project which is commercially viable, and that project is commercially viable where government policy is attractive and there is technology which makes it technically and commercially viable. So what do you say about this? That
Absolutely true.
what
And
is role of policy as well as the technology in financing any project, may it be the renewable or any other project? Thank you.
Thank you for that question. And I think you asked a very, very relevant question. For any sector to succeed and have to stand on its own, it is very essential to have a robust policy framework. I will here give an example of India. When Jawaharlal Nehru solar mission was launched in 2010, then there was only installed capacity of 10 or 50 megawatt in the solar sector in India. However, once the policy framework was there, the renewable purchase obligations were there, an incentive package was there. By 2015 or 2016, the capacity had gone up to 10,000 megawatt. And as the market matured, the incentive package were also withdrawn slowly, and other support was not required to make projects financially viable. And once the projects become financially viable on their own, the market can see investment coming up on their own. And I think this is where the policy framework, having a robust policy framework, plays a very, very significant role.
Thank you. Okay.
Thank you very much, Rahul Zadar. Since we know that we have wasted some of our time due to technical problems, so we will move to our next session. Thank you very much for your time and the nice discussion and creating an overall scenario of renewable energy in SAARC member states. So, ladies and gentlemen, we'll move to our next presenter, who is Mr. Ankit Vivek. Mr. Ankit Vivek is an Associate Director, Corporate Finance and Investment Banking with PwC India. He has an overall 12 years of professional experience with around 10 years across various sectors of infrastructure. Ankit has been part of various M&A, debt, and PE funding raise projects in infrastructure sector. He has special skills. His special skills are in the areas of business planning, market assessment, project structuring and planning, financial analysis, and revenue modeling, etc. He has a master's degree in management and is a graduate in computer science. So I may request Ankit Vivek to share about the key financial instruments for renewable energy financing. Over to you, Mr. Ankit. Mr. Ankit, can you hear us?
Yeah, I can hear you, Ishan.
Yeah,
Thank
please
you
go
so
ahead.
much, Ishan. Thank you for the kind introduction. A very good afternoon to all of you. Ishan has already provided a brief introduction about mine. I've been with the PricewaterhouseCoopers over 9 years now, and majorly doing transactions, both debt and equity in the renewable energy space. And incidentally, as in just to brief you, that I was also part of, before joining PwC, I was part of the renewable energy financing team of largest lender of India, which is State Bank of India. So we, being part of that team, I was instrumental in sort of giving finances to initial few projects. So I've seen this sector quite closely, how the financing has sort of moved way back in 2008, 2009 to what it is now. So, so obviously, then with this context, and then since all the SAARC countries are emerging economies, the emphasis has traditionally been on encouraging the lowest cost of energy generation, and that can only be sort of done when we have a cheapest source of capital as well. Therefore, it is good in this context that we are sharing all the learning that we have at in India. So I can sort of take you through in terms of journey how things have panned out in India, and so that if any their learnings are there, so probably that can be replicated in the various geographies. Just to sort of update you in current context, renewable energy has become sustained on its own in meeting the peaking power as well. So I think a week back there was a auction that was conducted by Solar Energy Corporation of India, which had asked for procurement of 1200 megawatts of power, and both for supplying the power in the peak hours as well as the non-peak hours as well. So what it means is that there was a storage system which was required, and the power which has been quoted is sub 4 rupees INR 4 rupees per kilowatt hour, which is less than the thermal power cost as well. So what it means is that over a period of time, the learnings which have been there in India, now renewable energy power has sustained on its own. There are no incentives as such is required, and it's in a position wherein entire power can also be replaced of the thermal power over a period of time, obviously. So, but it's become sustained over a period of time. So renewable energy financing is not only dependent upon the technological capabilities, experience, but also it's really dependent upon the regulatory environment as well as the technological experience which a particular country would have gone through. In this context, I'll sort of briefly touch base on the renewable energy financing, how it has changed in India per se, in terms of scenarios, ecosystem, etc. So as to give you some sort of a perspective how things have evolved in India per se. So pre 2008 in India, renewable energy market used to be driven by accelerated depreciation, wherein 80% of the project cost use can be depreciated in the first year itself, wherein entire equity is sort of a promoter used to get that back in the first year itself, which was sort of a incentive from a promoter's perspective. However, in 2009, 2010, the government of India took an initiative that independent power producers should be incentivized to bring up the capacities rather than just focusing on the accelerated depreciation, wherein there were additional incentives which were given, which Rahul also talked about briefly, which was on renewable power obligation, which means that individual discoms were forced to buy renewable energy powers. Also, there was a scheme which was provided by the centralized agency, which is MNRE, Ministry of New Renewable Energy, that incentive of 0.5 rupees per kilowatt hour will be additionally given to your independent power producer. So that really brought up the market because that made projects more bankable, and this really thrived overall the scenario of the financing from a senior debt perspective. So initially, if you look at it, how market has thrived, as in large promoters, likes of Hero Energies, Hindujas, and they have taken up some of the projects, as well as there were some of the management teams which were backed by large private equity players. So examples like of Morgan Stanley or Goldman. So these really thrived in initial years in 2010, 2011, when these projects got commissioned. With the learnings over the next course of 2 to 3 years, uh, lenders and various financing market got used to understanding as in how the renewable energy market really works, what are the sort of drivers which are there, and depending upon the learnings and the tweak will happen over a course of next to 2 to 3 years, how the financing needs to happen. So example, I can tell you that initial financing used to happen at P50 number, which is a probabilistic 50 number on resource estimation, which over a course of time, as the lenders learned that probably P90 number really works over a course of time. That's why they have started benchmarking their revenue estimations of P90 and looking at a comfortable DSCR, debt service coverage ratio of 1.2 to 1.25. And that's how over a period of time, the lending market evolved. So just not that. With this, and then lenders took learning on various parameters. Example, what state, how the financing of the individual discom is there, how the economic health of discom is there, then technology beat wind, beat solar, within wind, solar, and then what are the different modules or different technology really works. And depending upon that, they have really worked out on the granularities of each financing term to work out on the financial numbers as well as the covenants probably they are looking at it. So so renewable energy obviously is been a focus, and more so in context of Kyoto Protocol and Paris Agreement. And like I told earlier, then India is now sort of looking at it that renewable energy has become more independently viable rather than being thrived initially, which was the case in 2010, 2011, where government used to give incentive, and over the period of time, those incentives have been taken out because economies of scale have been built up, and renewable energy power has become competitive over period of course. So I think important is to sort of understand how these projects sort of can be financed. That's become the key factor, because the kind of capital expenditure which is required in these projects, it's important to get them financed, and more so from a perspective of how they can be levered up by adequate amount of a debt. So in order to meet aggressive timelines and aggressive targets on the renewable energy power, so we just need to sort of look at what sort of a policy interventions can happen, as well as what sort of international markets that can be tapped, sort of, so those renewable energy projects can be financed. I think important would also be from a perspective of a particular government, if an incentive can be given by way of giving a priority sector lending tag to renewable energy power, that really helps in the overall financing environment to sort of give finance to renewable energy projects. So to make it viable, I think it's really important to engage all the stakeholders. I think important is government to play that role. Then financial institutions which are in a particular country, they need to sort of understand, they need to get experience, and probably they can start with the initial few projects, and they can take experience from the neighboring countries and all. And then with this experience, a lot of confidence also comes in. So while initial few projects might get funded by way of some sort of a support, maybe to the large groups, or maybe supported by large private equity players, but over a course of a period, this experience will give credence to overall project, and the projects can be sort of given financing on an independent basis rather than looking for some sort of a support. So some of the challenges which we had seen in India initially were unfavorable scale of a project, which is sort of small scale projects used to be there. So if I recall, as in initial years, way back in 2010, the cost of procurement of power used to be up to INR 20 rupees per unit. But at that point in time, government had taken a call that we need to thrive renewable energy sector. So that's a sort of an incentive, or the commitment that was given by the government to procure that power. Then another constraint which we have seen was on the context of long-term funding available, because that inherent is a asset liability mismatch from any of the financial institutions point of view. If they are sort of getting the funds from the consumers or the retail customers, typically they look at 1 to 2 years sort of a borrowing, while the funding that they're looking at is from a 18-year 20-year perspective, because that's the tenor of the project life. So that's really is one of the key issue which we had faced. So initially, some of the large institutions like State Bank of India or Punjab National Bank, those were the initial banks who had taken a call, and those calls were taken by the for the initial few projects, wherein the large year fundings were given, typically to the tune of 15 years and all. After some time, I think specialized institutions were formed who were responsible for the infrastructure funding, and those were backed by the government. So new institutions like India Infrastructure Financing Corporation Limited or L&T Infrastructure Financing, those were the specialized institutions that got created over a period of time to sort of fund these large projects, who were in turn backed by capital borrowed from the bond market, which was sort of a long dated capital, not a short term capital, which was in case of some of these banks. So this was sort of a initial few thoughts, and then I'll just sort of a deep dive into each of these financial instruments that we sort of look at. If you look at financial instruments, then these can be categorized into four buckets. One is especially debt financing instruments, having forming part of more than 70 to 75% of the project cost. That really becomes important component overall project cost. Then equity financing instruments, I think depending upon where the projects are, what is the sort of a capability of group, what is the sort of a operational asset, under construction asset. So these really depends upon a lot of factors, including status and size of the portfolio. Then guarantees and insurance, these have been recently been talked about, how these can sort of overall help in terms of helping the renewable energy market. And these really come from a fact that, because whenever the investors are there, investors are coming from the foreign geographies and they are looking for their return and the surety or the risk on the return, when they are looking at it from a dollar perspective, because they are bringing financing in the dollar, and they would obviously be looking at returns in the dollar terms. So these guarantees really become important, how if uh, returns can be structured more to suit their requirement. Recently in India also, we have seen that some of the innovative financing instruments have been talked about, and these instruments are more to sort of help renewable energy market overall, and also from a perspective that what are the new sort of revenue streams can be looked at. Also, if projects have already been commissioned, how can a rotation of the capital can really happen? That also is important, because once the capital rotates, there's a capital which gets free, and capital, once capital gets free, this can be plowed back into new sort of a projects. So this is just the overview of the financial instruments. We will just talk about each of them in detail now. So first is the debt finance. uh, Debt is really important parameter for overall perspective, because it's forms 70 to 75% of the project cost. And typically the funding is from large financial institutions like banks. They could be multilaterals, that could be World Bank, that could be ADB. So those sort of institutions needs to be tapped out. There's another sort of a layer of funding which is we call as mezzanine finance. Mezzanine finance sits between the senior debt and the equity holder. Uh, Subordinate debt, or mezz finance as we call, it's really evolves over a period of time. So just to sort of relate it to Indian example, in 2010 2011, when the projects were just evolving, the mix of senior debt and the equity used to be there. There was no instrument like mezz finance at that point in time, because uh, from a lending perspective, as in they wanted the skin of the promoters to be in the game. That's why they were just looking at from a equity perspective, that money should be there and remain there for over a period of time. However, with 2 to 3 years, 4 years of experience in the performance of the renewable energy projects, there was a initial cushion which was created, and there were the specialized institutions which got comfortable with the working of overall renewable energy commercial perspective, wherein they suggested that they will be able to sort of finance a small layer, maybe 10% or 15% of the layer, which can be topped up on senior debt. So if we are looking at a senior debt to give a cost of capital in low teens, and equity holders are looking for a return on the high teens, they'll this mezzanine really helps in bridging up the gap, that which sort of a look at return at mid-teens. And having replaced the equity holders by mezzanine debt of mid-teen sort of a capital, this really helps in increasing IRRs for the equity holders. So this is majorly on the senior debt part of it. And then debt will be advantage in debt is that will be at the level of the project SPV. So majorly the collateral or the uh, security that will be given for this sort of a financing would be the assets of the SPV, and obviously cushion will be to the extent of the equity holders. Challenge which we have seen is that local commercial banks in developing countries are reluctant to extend long-term financing. That is probably from a perspective of asset liability mismatch. Instead, they try to offer a mid-term loan with the potential to refinance at the end of the term. So that's a sort of a bridge which has been formed. However, as in over a period of time, there are specialized institutions which have been created. Probably those institutions can be created in other geographies as well, who can sort of borrow from a long-term capital sources like bond market, etc., and then they can give the long-term capital to these renewable energy projects. So in terms of mesh debt, we briefly touched upon that advantages. It improves the cash flow in the project and reduces the risk of the senior lenders. As a result, the willingness to lend and to accept long-term finances increases. Challenge, obviously, yes, as in this, they will be looking at a mid-term returns, mid-teen returns, which sort of is a replaceable one. However, and then the advantage to that extent is that it increases returns for the equity holders. So on the public funding slash grant side advantage, we see that main motive to provide renewable energy access to the population. This is the sort of overarching sort of thesis, but there is no sort of a expectation or lesser expectation on the return side. uh, Challenges which we see that usually these sort of a financing is sort of available, has a limited sort of a overall pool of the capital, and this is sort of really available on low per capita income group, and this not so much developed per se. So coming on to the equity financing. So, so broadly, we can club equity financing the four buckets, which is venture capital funds, private equity funds, infrastructure funds, and the pension funds. And if you look at sort of these sort of a buckets, they have uh, each bucket has its own definitive way to look at how and what kind of a transaction that they can really do. If you look at the venture capital funds, venture capital are more focused towards technological bent within the renewable energy portfolio. It could be electric vehicle space. It could be something with respect to nuances to enhance energy mechanisms, etc. But that typically remains towards the technology part of it. And these are not the funds who can do millions of dollars of funding. They will typically restrict themselves to a couple of dollars or something there, because they are just making it happen to sort of give a thrust for any technological idea to blossom over a period of time. However, if you are looking at a private equity funds are sort of funds who can deploy large source of capital. They have experience in infrastructure, but just not the infrastructure. That's why they're not categorized as infrastructure funds, but they do have experience, and they can sort of back large management team who has gotten experience in this sort of a platform, and who can really do that, who can scale up the platform to next level. So I can give you an example. As in initially, when in 2010 2011 was there, Morgan Stanley backed one of the developer or the management team of Continuum Energy in India. So Continuum Energy promoters would have contributed some $10 million of funding from their perspective, but large pool of chunk of money had come in from Morgan Stanley, about $200 million, to take this platform to a gigawatt platform. Similarly, Renew got backed up by Goldman Sachs, wherein Goldman Sachs had committed about $250 million of fund, and they backed a gentleman called Suman Sinha, who had prior experience working with Suzlon, who was into renewable energy. So private equity funds are the ones who can deploy large sorts of capital. Infrastructure funds are specifically who have gotten expertise in the infrastructure, and they can tap large source of financing from overseas. So examples could be I Squared Capital, and then they have formed a specialized infrastructure fund to sort of deploy large scale of capital in the infrastructure space. And typically, if you look at it, the horizon of exit is also larger from an infrastructure funds perspective. And since it's a larger pool of capital, their return requirement is also slightly lower. Pension funds are the specific category of funds, because it's the money of the common people which has been parked as insurance money or pension money. So that pool of capital is needs to be less risky asset, while in case of private equity funds, infrastructure funds, they can back higher riskier propositions. So higher riskier propositions could be under construction assets, because the risk associated will be on many fronts, be it land acquisitions, be it on tying up of the power offtake, or being tying of the grid offtake. So however, in case of pension funds, they would not be able to take that risk. So from a pension fund's perspective, they typically like to invest in the operating portfolio of assets. So if you look at it in India journey, a lot of pension funds have invested in India. Example, CDPQ, which is a Canadian pension fund, CPPIB, which is also a Canadian pension fund, and many others, Alliance, which is a German fund, many others have sort of invested in Indian renewable energy space, and they continue to do so because over a period of time they have got a lot of experience. They started with uh, operating portfolio, they have backed large platforms, and they continue to fund those platforms to sort of increase their portfolio. Coming to next slide, and then we have just given a snapshot of sort of who could be the investors in each sort of bucket. So just an example has been given that Mitra Energy raised some $78.5 million from IDFC Private Equity, then $19 million from PTC Financial Services. Similarly, Azure raised some $36.5 million from Germany's DEG. Subsequently, Azure got an investment from 3DPQ. So there are multiple stories to it. There will be multiple investors who have invested in multiple platforms in India over a period of time. Coming to next, which is guarantees. So guarantees really become important in some of the space, some of the nuances to capture when we are looking at a various risk, because each country will have a different risk, and to cover that risk up, uh, uh, different sort of a guarantee need to be looked at. Government guarantee essentially to back the Discom, that in case that Discom is not being able to meet any sort of a obligation on the power purchase side, the government will stand by and honor that obligation. So that really becomes important from a perspective to make it more bankable. Any incoming investor or the foreign investor who's coming in any particular country, they would sort of look at then what is the rating of that particular country, and then adequately sort of look at reserves, multiple things, and then they will be sort of a banking on projects in that particular country. Political risk is generally covered as part of power purchase agreement that gets signed, wherein in any scenario where there is a civil disturbance or political events such as war, terrorism, insurrection, sabotage, and terrorism. So these scenarios which are rare, which happen, just to cover that whatever the capital has been deployed, those sort of a capital needs can be paid by the government, because that is something outside the control of particular investor. Currency risk, I think it's really important to understand currency risk. While this is being debated, and some thoughts are floating around in India as well, because when we are looking at a capital to come in, I think it's important the foreign capital needs to come in a particular country to sort of give fillip and put more capital to deploy, to bring up more projects. So when this capital is coming, the inherent thing is that they will be deploying the capital, or they will be committing the capital in $1 million. When they're taking back that after investment, the revenue starts flowing in, that revenue needs to be sort of go back in terms of dividends or interest payments in terms of dollar terms only. So they will be weighing their options, that what sort of a really works, what are the options that they have, what are the strength of the country is, what sort of a currency depreciation has happened over the last period of 10 years, 15 years, 20 years. Then weighing all those options, they look at IRRs or their returns in the dollar terms only. So to make project more viable, a thought process has been started that why not the government take up that risk on the currency side, because current currency is something which government activities really hold overall from that perspective, and the PPAs can be signed in dollar terms only, so that when an investor is investing, they are reasonably sure what sort of a returns that they are taking back home. So this is also an open thought. So while there's some thoughts which is moving around in India also, that if such sort of a PPAs have been signed, we haven't seen yet those sort of a PPAs, but these thoughts are moving around in India as well. Then Coming on to innovative financing instruments, I think lately in last 2, 3, 4 years, a lot of buzzword is moving around on new sort of a financing that can be gauged up to free up the capital. One important, I think we have seen, is that green bonds. So green bonds, while the market has thrived in last 2 to 3 years, I think India and companies have raised up to $7 billion. Uh, Green bonds are essentially bonds only, which is subset of corporate bonds only, and they will have a fixed coupon, and they will get redeemed at the end of the tenure of the loan. So these are specifically raised for the purpose of investing into the green market, and so to say that these projects, all the renewable energy projects, etc., will get financed. So, example, as in India, then Yes Bank was instrumental in raising a lot of green bonds for some of these companies. They had formed a fund within Yes Bank, and then they deployed that capital to various sort of companies in India itself. So how it really works is that investors in various foreign geographies, and then who have inclination to invest in green energy, they sort of put that capital and they put it into a fund. That fund gets deployed to either local financial partners or directly into the renewable energy portfolio. So that is really a bond market transaction that we are looking at. Coming next is the infrastructure investment trust. This is the latest buzzword which is there in India, and that too specifically, it's a capital market sort of a transaction, wherein the freeing of the capital really happens for the developers. This is also to give a fillip or rotation of the capital. The intention is to rotate the capital. So developers will really flip over the operating assets, and these operating assets which will be forming part of a trust, and the units of this trust will be allocated to the shareholders. So essentially, likes of all the pension funds, sovereign funds, these are the target market for the infrastructure trust, because it is essentially been targeted to rotate the capital, and it is being mandated by Indian government that only 90% of the portfolio of these infrastructure trusts needs to be operational assets. Only 10% is allowed uh, to the extent in the under construction assets. So this is idea is to rotate the capital, and that's why infrastructure trusts have been brought in as a concept. Also, just to sort of incentivize, government has also given some sort of a tax incentives. For example, dividend distribution tax has been waived off, and there are some sort of a leeway which have been given on the withholding tax also when the interest repatriation happens from a SPV to the InvIT. So these sort of a specific on special concessions have been given to make it more viable as a concept. Coming to next slide, carbon financing. So clean development mechanism, carbon financing is a mechanism which is intended to contribute to ultimate objective of UNFCCC. This was prevalent way back in, I think, in 2012, 2013. And the genesis of this was that when the obligation was coming from various accords, while European countries were not able to meet that obligation, they were interested in taking that CDM benefits, and they would buy that to meet those obligations. But lately, what we have seen is that this is not really vibrant, so to say, as a market. But yes, often and then we keep discussing about it. Next three, while these are referring to small scale projects and all, so we haven't seen much sort of a development in these sort of a ones. So Ismail, next is small scale project financing. I think this is more to say for small scale wind power projects or solar power projects, and this is sort of a in India. State Bank of India has tied up, for example, with KFB. KFB is a development finance, KFW. So KFW is a special financing institution, and then who looks at sort of incentivizing the development of a small scale solar power projects. So with the financing backed by KFW, uh, State Bank of India is giving fund to small solar projects at a concessional rates. So just to incentivize small scale project development. Asset-backed securities is essentially the debt fund which has been raised through bonds, primarily backed by the cash flows that get generated from a renewable energy projects. So this is more to be seen. This is more securitization of the cash flows which is there. In Indian terms, I think we have seen that this typically being led by the traditional financial institutions like bank and all. However, this is not to be seen as a bond market transaction, which is still in infant stage and it's developing. It is more so to perspective of a developed market, and we have seen some sort of a transactions happening in the US market. But in India, we are sort of a developing bond market to sort of a finance this up. Some of the investors, as in who are sort of a prevalent in the securitization market is Mosaic in US, then Sonova Solar Energy US, AES Distributed Energy in US. More to say with who have experience and who have seen this sort of a development over a period of time. More from a developed market perspective. Next is microfinancing. Microfinancing is part of a banking financial services, wherein the quantum of loan is very small. Typically, could be ranging from $100 to $25,000. Primarily backed by microfinancing institutions. The disadvantage of microfinancing institutions is that there's a sort of some form of informal market also plays in, and that's why the cost of capital which is being sort of a source from microfinance institution is on a higher side. However, then this is just to sort of incentivize coming up with a new projects, maybe a rooftop projects, to sort of meet on its requirement. We have seen, I think, majorly microfinancing to be worked out in Bangladesh solar space. So in India, and then specifically SKS Microfinance served a large number of clients way back in from 1998, and it has become one of the biggest microfinance institutions in the world. I think this is more from a overall financing perspective. If you have sort of any queries for a specific section, or if you have overarching sort of a query to sort of ask in terms of India market, otherwise, we will be happy to sort of answer that.
Thank you very much, Ankit. It was indeed a very nice presentation. In fact, we have, although we are short of time, but we will take some few quick questions. We have a question that can you share us about the present rate of energy unit in respect of solar, wind, and thermal to have a comparison of a big leader in energy sector? Did you get my question?
Yeah. So, sir, is it for India that you want to know or for global?
Yes, exactly. India being a leader in energy sector, we would like to have this.
Understood.
As we were sort of going through it, as in initially when we were in 2010, and we have seen the borrowing costs from the initial solar projects were up to as high as 20 rupees per INR. But as the market has matured and the reverse competitive bidding has been taken up since 2016, there's a lot of competition has come up and large scale projects have been developed. So we have seen that cost of generation for these wind power projects and solar projects have come down significantly low, and now it stands lower than INR 3 rupees per kilowatt hour. And as I touched upon,
sorry, how much?
I'm less than INR 3 rupees per kilowatt
hour. We are not getting it. How much amount per unit?
INR 3 rupees per kilowatt hour.
3 rupees.
I'll explain it to you. in India, if you are doing a procurement through conventional power, that is thermal, it is priced generally at about 4.5 rupees, of which the coal cost itself varies anywhere between, anywhere between 2 to 2.5 rupees, depending on logistics. If you look at solar, now in solar the issue is slightly different. Part of the reduction in tariff is because the investors expect a lower return on equity. And part of it is because once constructed, the solar has much more predictable cash flows. But taking that into account, if you are looking at a mid-sized solar plant, the cost would be anywhere close to 3 rupees. If it is a very large power plant which goes into quarter of a gigawatt size capacity, the tariffs might fall slightly below. If it is, let's say, sub 50 megawatt capacity, then the cost can actually go up to about 3.5 rupees. Rooftops generally get, the tariffs at rooftop capacities, although the capital cost is low, but because of the size of it and the financing cost, etc., the lesser generation, rooftops typically go at trade at maybe just less than 4 rupees, just around hovering around that 4 rupees mark in India. So this is broadly the thermal comparison versus renewable. I think part of it is also because part of the cost reduction is also because the expectation of especially investors who come and do secondary trades, that is buyout capacities after construction, their expectations of return is lower because the predictability of cash flows is better and the operational risk is far lower than in case of thermal.
Thank you. We have another question that it's quite relevant to the previous question. That does India have thermal power projects based on LNG? And if yes, what is rate per unit for specifically this LNG projects?
So yes, we have a few projects which are based out of LNG, and there are two reasons for that. One is specifically if we look at certain captive power units which supply electricity to large refineries are based on LNG. And second are capacities which were planned on the backdrop of domestic gas. But essentially, I think all of us have heard news that domestic gas production did not hit the numbers that we were expecting, and a lot of capacities ultimately came up. So many of these capacities also are driven by LNG. Now, typically, in case of LNG, the variable cost itself is in excess of 5.5 rupees if it is purely running on LNG, that is capacity. And so overall net purchase cost could be anywhere close to 6.5 rupees on the minimum, considering debt, etc. But having said that, I think what countries are also exploring where gas production is less is whether they can do either blend at an input end or blend at an output end. So when I say blend at an input end, that means mix RLNG come domestic gas, but that is slightly tougher to do. Or they could do blending at outside or on the output end, wherein capacities of gas-based plants are hybridized with capacities of solar, and the average net, I mean, it can give the same benefits as a conventional thermal or a coal-based plant, but the net generation, the net cost will be far lower than pure RLNG projects.
Thank you very much. Thank you. We have another question that what about, it's from Afghanistan. They're asking about the crowdfunding. That can you explain this mechanism and please state if there is a successful experience in the SAARC countries?
Not much in SAARC countries, I would say. Crowdfunding. The crowdfunding, one of the most successful examples come from UK. Now, typically, we also need to understand why it was successful in UK. In UK, sometime during the prime ministership of David Cameron, he came up with, and in order to give a push to renewables, they came up with two policies. One was that they levied something called carbon tax on inheritance tax. So basically, if you're a large HNI person and there is your future generation is going to inherit a lot of wealth, then they'll be taxed heavily if there is no carbon offset. That was number one. Number two, what they also did was that through Prime Minister's office, they ran something called a nudge campaign, which is to basically tell people that it is good for the entire world and for your country to adopt renewables. So it was more of encouragement that was being provided. Now, through this, there were certain funds because the biggest challenge with crowdfunding is that you need a pool vehicle. So you need some vehicle which pools small amounts from individuals and then fund it in a more economic manner. So there were certain private equity funds. The most successful one I could remember is a fund called Octopus Capital, which basically raised funds on crowdsourcing basis. They invested it into primarily into rooftop and small solar projects of a company called Lightsource, which eventually went on to become the largest renewable player in UK. And it was bought out by BP somewhere in the last 2 years. They bought it out. The good part is that even though this was crowd-funded, the return that investors got on this deal was about 150x of their primary investment. So it worked out well in UK because there was a nudge from from the government, which was like running a large program saying that saving investing in solar or saving carbon footprint is the most patriotic thing to do and stuff like that, and backed with a tax measure of on inheritance tax, which led to a lot of people investing. But that inheritance tax has been done away with when the new government had come into, post David Cameron's tenure being over, the inheritance tax was done away with. Now you don't have a lot of crowdfunding uh, in UK, at least direct funding. Was I able to answer?
Yeah, it's very clear. And there is a connected question from the same group. This is basically a group of 20 people from Ministry of Energy of Afghanistan, and Mr. Ruhala is leading that. He is actually corresponding with us. So they have a connected question that how much is the capex for solar energy per megawatt with or without back in the SAARC member states like India?
Okay, so in India, we are able to close projects at a capital cost of roughly about 4 crores a megawatt on a grid connected scale. That is basically if it is connected to the grid. If it is a solar project, then somewhere close to 30, 33, 32 lakhs per 100 kilowatts.
So just to add to what Sandeep is mentioning, I think it really depends upon the scale of the project as well. So if you're looking at a scale of some 100 megawatts plus, and then you can try to achieve or you can aspire to achieve cost less than 3 crores per megawatt. However, then on a ballpark number, if you look at it on an average basis, we can sort of assume that projects should get commissioned between 3 crores to 3.5 crores per megawatt.
You need to take the grid cost also.
That's not the cost.
That is the cost of the substation grid.
I believe I should give a chance to Mr. Ruhala directly so that he can have his question, because he has on his back a group of two ministries. One is the Ministry of Finance and one is the Ministry of Energy. So, Mr. Ruhala, can you hear me, and are you able to on your mic?
Yeah, hello, Mr. Marwat. How are you?
Yeah, I'm fine. Thank you. Welcome to the forum, and I'm giving you the mic, please.
Thank you so much for organizing this webinar. As I stated before, we are colleague here from MEW and Ministry of Finance. My first question was about crowdfunding.
Yeah.
how this mechanism works in Shark State, or do we have any successful experience in this region? And the second question was about the capex for solar energy in the Shark region, and how much is the per megawatt for solar energy?
Yeah, that's what they have addressed. If you have any other questions, or you can have a
Yeah,
connected question.
my colleague from Ministry of Finance has a questions, and he will elaborate it by himself.
Good morning, Assalamu alaikum. This is Uzair Ahmad from Ministry of Finance, Director General Public Private Partnership.
Hello, sir.
Welcome, sir. Welcome, sir. Please go ahead with your question. It's an honor to have you.
Thank you. Thank you for arranging the session. The question is that what is the per megawatt capex for solar energy, both grid connected or backup? And the second question is that what is the security and insurance cost you consider in the solar projects?
Thank you,
Okay.
sir. Sir, over to our presenter.
Yeah, thank you for the question. So, if it is a ground-mounted system and just to build the system, that is just to build the solar plant, it would cost you roughly about 3 to 3.5 crores, inclusive of the transmission network that you might have to build, substation evacuation, etc. Because anything above 50 megawatt might need a dedicated substation. The cost could go up to close to 4 crores a megawatt. That being said, if it's an off-grid small rooftop project, then the cost is about 20-30% lesser, because you don't have to build a lot of structures, etc. As you might have to build in the case of a ground mounted project. You don't need land acquisition cost, etc. If it is backed with a battery backup, and I believe that's what you were referring to, then the cost would go up to close to about 6.5, anywhere between 6 to 7 crores a megawatt. The latest price which was discovered in India was also close to 4.5-5 rupees. It was quoted by Mahindra, which is a large renewable player in India. So, this is broadly the ballpark figure that you could see in terms of cost of project. So that's number one. Number two. Pardon me. What was your second question, sir? Could you just repeat?
Yes, Mr. Uzair, can you repeat your question?
Yes, the second question was regarding the security and insurance cost per megawatt. If I'm not confused, if I catch your response correctly, so you said for without backup, it is 4 crore per megawatt, right? And with backup, it is 6 to 7 crore.
That is right.
Right? Okay. So, what would be the security and insurance cost per megawatt?
Pardon, sir?
Security and insurance cost.
Security and insurance cost per megawatt. But Mr. Anik, I will request if you can calculate the values in US dollars for the convenience of everyone.
Yeah, that will be perfect.
Sure. So the capital cost for project $500,000 per megawatt, a little over $500,000, about 600,000 per megawatt in case of a grid connected system. In case of sorry, can you repeat?
You said that will be 5 to 600,000 USD per megawatt, just for building a solar plant, not transmission line and other things, right?
No, sir. Including transmission line would be about 0.6 million per megawatt.
0.6.
0.6 million. Okay.
Yeah. And if is a rooftop project, then the cost is about 0.4.
0.4,
Right, Mr. Is there any other question?
Oh, thank you so
Yeah, and
much.
on the insurance cost.
Yes.
Yeah.
Yeah, on the insurance cost, see, the insurance cost is very, unfortunately, we do not have a large and deep insurance market in India. There are some private insurers like ICICI, etc., who have recently launched insurance programs, but to the extent at present, the only thing that is being insured is the capital investment. Now, in capital investment, there are two different models which is available. One is insurance or security backed on a gross, on the complete capital cost, and the second is on depreciated cost. Net and net, it could range, depending on the kind of player, it could range anywhere between 0.05% to 0.1%.
Of the total capex?
No, apart from that, ridiculous. So,
Yes, sir, on capex.
so it really depends upon the
Player also.
strength of the promoter, depending on how much they can negotiate and all, and the quality of the build-up which is there. So it can vary from 0.05% to anywhere between 0.15%. And obviously, it will also depend on the kind of a technology you are looking at it. So maybe a hydro project, which is also part of a renewable energy, there the cost will be higher. While if you are looking at a wind or a solar, their cost will be slightly lower because that's more less maintenance and less riskier in comparison to hydro.
So, Mr. Ruler, shall we move to our next presenter? Because we are running short of time. So thank you very much. Thank you very much, Ruler, Mr. Baer, and particularly our presenter, Mr. Vivek. Thank you very much. So let's move to our next presenter, who is Mr. Sandeep Kumar Mohante. Sandeep is Director Energy Power and with PwC India. Sandeep has over 10 years of professional experience in management consulting and has consulted a number of Indian firms, global utilities, and private equity clients on financing strategy, market research, financial modeling, commercial contract review, and strategic advice on growth, market entry, and expansion. In addition to India, Sandeep has worked in different parts of the world. He has a master's degree in business management, specializing in finance and strategy, and is a graduate in computer science engineering. So I may request Mr. Sandeep to share the findings and recommendation of the study report with the participants. Over to you, Mr. Sandeep.
Sure. Thank you, Asanji, for giving us this opportunity to speak. And I think thank you for also introducing me to the largest SARC member team. So let me just quickly jump on to the recommendations that we are proposing on an overall SARC country level. And we have kept it short. What we will do is we'll quickly run through the broad headlines and take up more questions on individual countries and the challenges and if anything that could be asked to us on that scale. So moving on to the first step, institutionalizing the clean energy policies. Now, essentially, there are two ways in which renewable energy can move. And today, because renewable energy per se has achieve the right economics to make it beneficial for investors to invest. Still the question comes up that why do we need policy or can we have completely deregulated market? In reality, the problem is that in most of the SAARC countries, energy is primarily regulated, which means that we need to have right policies instituted in each of the countries to make sure that we are able to attract capital, we are able to mitigate risk for the investors coming in. Now, any investor who invests, and specifically if you look at infrastructure sectors or any of the infrastructure sectors like renewable, there are two essential things they're concerned about. One, are they making adequate return? And two, how much risk? And this is a very very generic statement, but it has a lot of weight when we are looking at policies as well. Because if we want to ensure that the rates of renewable energy is the lowest, and we are able to deliver the lowest cost energy to our consumers, we need to ensure that the risk for investors has been minimized to the maximum extent. So, having said that, one of our first recommendation, we believe that today there is a lot of concentrated development among SAARC member nations. So we have an excellent, a small solar scheme which was very successful and implemented in Bangladesh. Whereas in India, we have seen a large IPP programs being quite successful. In Nepal and Bhutan, because of owing to the geography, we have seen hydro being very successful. So the idea is that I think as collectively as a region which is emerging, which is developing, and which is energy hungry, we need to institute more collaboration and have some seamlessness of policies between member nations, so that it is easy for three things to interflow between countries. One is human resource, the skilled human resource, technology, and capital. If we are able to create that, I think we will be able to achieve a lot more parity in terms of development of various SAARC member nations. So that's the first recommendation that we had. If you look at policies, it can be classified into four broad buckets, and that's what we have segregated. The first is energy policy, which is more about how the public sector is interfacing with the private sector, or basically the investors in renewable case. Feed-in tariffs have been substantially successful in the early periods of development, both in India as well as if you look at examples in Latin America, where feed-in tariffs have been quite successful. In Europe, the feed-in tariffs have been quite successful. I think in the early days, the feed-in tariffs were very successful because there wasn't a real market discovery mechanism there. There were only limited investors. Hence, it was quite useful. Second was tax incentives. Now, again, many of the countries are doing away with tax incentives, but having tax incentives helped. And I think I described a little earlier about the inheritance tax issue in UK. It was a great hit. In India too, we had something called an accelerated depreciation for renewable assets, which was earlier pegged at about 80%. Now it has been brought down to 40%. But because we had these tax incentives, a lot of HNI clients actually saw renewable as a route for investment. So when we were talking about also crowdfunding, I think if we really want to attract crowdfunding, we have to make sure that individuals see renewable as a source of giving them the right risk adjusted returns, and part of it could be given by ensuring that they're adequately incentivized on tax side. The third is about quotas and targets. So, what essentially we have done, and this, if you could take the example of India, is that we have set something called as an RPO target, which means that if you are an energy consumer, either it be a distribution company or you're a captive consumer, you have to minimum, a certain amount of procurement has to be done through renewable sources. That too, in India, we have broken it down into solar renewable targets and non-solar renewable targets. Now, essentially, this is not something very different from the UNFC targets that we used to have. So there also, every company has to adhere to certain carbon targets. Here we have more or less evolved that to our own market, and just within the country, that every consumer has to adhere to certain RE targets. And on the back of it, we have created an RPO market that has not been very successful in Indian context, but because of different, various execution issues. But as far as the concept is concerned, it was a very strong concept, wherein if as a consumer I'm unable to meet my renewable criteria, I can go to the market and buy RECs to offset it. And the RECs were market price determined depending on demand and supply. There was a certain floor threshold which was also there. So this is more or less the kind of energy policies that we can see. Then there could be financing policies, and my colleague earlier in his presentation on infrastructure index, for example, in some of these things, where you can have policies which are targeted towards raising funds, and typically these policies are not issued by the energy departments or the ministries, but these are generally taken care by the central regulator, monetary regulator, the central banks, or the finance ministry. Then you have the public finance program. Now, typically the public finance program implies that government puts in money. Now, there are multiple ways, and we can talk if somebody is interested on in which way government can put in money. Now, one of the way could be directly funding a project. Others could be basically institutionalizing a financial institution through which government can provide capital and they can relend to investors, or third could be giving support in terms of non-fund based capabilities such as guarantees or warrant or guarantees or certain bridge financing facilities, etc. So the public finance programs can come in different ways. Different countries we have seen across the globe do it different way. For example, in many of the small and emerging nations, if we talk about Africa and elsewhere, there the public sector directly invests money and to build solar capacities. That could be one. The second could be basically in form of giving some sort of subsidized loans, etc., or a viability gap funding, which was prevalent in India, for example. We could go to another extreme end where governments can provide either a hedging facility or some sort of guarantee support which can help investors raise low cost funds, like we have seen a lot in Latin America, like example Chile, etc. So these are different kinds of policy programs that could be instituted depending on the maturity of the country and the way that we are, how deep our capital markets is, how deep our electricity market is. We should tune our policies according to that. And the other thing we should be very careful is that the policy has to be dynamic. We cannot have a policy which we think will be there for the next 20 years, because what we have seen is that unlike in the conventional side where a change used to take about a decade to come, in renewable, because of its close proximity to semiconductor and all, every change can happen in every 3 year and 5 year cycle. So we need to have a policy which we believe can be dynamic enough to cater to a very short and medium period of time. So that's my limited, point that I had to talk about in this. Second, in case of, and what we need to be cognizant is that there is a difference between the Western regions and the difference between our SAARC nations, where electricity is a very sensitive subject, as well as there is a lot of public sector involvement at some point in the entire electricity value chain, which means that there is, when it comes to financing programs and public sector money flowing into either onto the private hands or to corporate hands, in that case it has to be managed by very independent and professionally managed organizations. We have seen in cases where it's not through an institute which is professionally managed. There could be issues surrounding either corruption or mismanagement, or even but the biggest problem is that we tend to end up being non-economical in distribution of funds. So that is the biggest challenge when we look at it not being managed by independent organizations. Typically, we have given some of the independent organizations name here, which are public or DFIs, etc., across different countries. In India, also we have certain institutes. For example, IREDA, which is a central government funding institution, and the next slide actually talks about IREDA, which was set up as a public limited company. IREDA played a major role in the early, because right now at least the financing market has become more vibrant. But during the initial days of solar funding back in early 2010s and 12s, IREDA played a huge role in funding renewable projects along with IFC. I think these were the only two institutions which used to lend. Today, IREDA is become completely independent and autonomous. It does not rely to a large degree on government source of funds. Earlier, it used to. Today, it is as an autonomous institute. It is able to raise, for example, it raised a substantial amount of green bonds from London in recent times at a very attractive rate, and which was used for on lending to renewable projects. So I mean, gradually, while it relied initially on the public funding, gradually it has become now a very autonomous institution. So this is the kind of trajectory that most countries could look at in terms of their central financing institutions. Third, and this is very critical and specifically for SAARC nations, is reduce the cost of renewable energy technologies. The challenge today is that, barring a few developments, barring a few companies here and there, most of the renewable energy technologies is either controlled by the Western Bloc or by the Eastern Bloc. Now, today, of course, because the we have liberal policies in terms of trade and all, so it is at least the development of renewable energy has been more seamless. But what we also need to understand is about in terms of energy security, we need to have certain degree of self-reliance in terms of renewable energy. The second bit we also need to see is that renewable energy technologies by itself can create a huge market which can give employment to public within individual countries. And some of these examples we have shown. And even though in India we say that we are actually doing some bit of manufacturing successfully right now. There are some large companies which have invested and are now coming up with quality products, but still we are not to the scale and the scale and the size and the kind of supply chain integration that a China or a US or a Germany at some point of time have done. So to be honest, I think we still as a region lag, and it is important that we ensure that technology, there is adequate investments in technology, in higher efficiency technologies, and these investments and this technology are then allowed to flow freely across boundaries. I think that this is very crucial. We need to ensure. So basically, in short, we need to ensure skills, free movement of skills, free movement of capital, and free movement of technology. If we ensure these three things, I think as a region we can do extremely well. Some of the other measures, and I have a slightly different opinion when it comes to auctions and auctions in case of renewable energy. I think globally we have seen auctions driving down the prices significantly. We witnessed the same thing in Middle East, where the plants were getting commissioned at about 2 cents or 2.5 cents. We saw renewable energy prices driven down in auctions in Mexico, and we witnessed same thing in Brazil and also in India. Now, while auctions have been largely successful to bring down the cost, we have also seen that auctions has a very mixed success rate when it comes to delivering projects. Now, why do I say that? Is that in some of the countries, and especially when we look at the Western counterparts or even Middle East, while the auctions were happening, the contracts were of such a nature that it allowed the investors a lot of risk mitigation. It allows the investors to be assured that if they are putting in capital and the project has been commissioned, their payments, etc., flows on time. So once the project is commissioned and after the development risk, it essentially becomes a riskless investment for them. The same can't be said about SAARC countries as well. So that's the reason why, even though investors with certain expectations bid very aggressively in renewable energy projects, at times because both we have a very volatile market, unlike the West where markets are very stable in terms of interest rate, etc. The other is partly because we are not self-reliant in technologies. Sometimes it is the capex is driven by demand supply elsewhere in the world, which has nothing to do with countries here. As well as because of non-performance of some of the utilities on the downward side, which impacted the cash flow and viability of the projects which were delivered under auction basis. So the auction, so just summarizing, auctions are a great way to bring down prices. I think that's a way in which competitive price discovery can happen. It ensures transparency, reduces any foul play in the process. But at the same time, when we're doing auctions, we also have to ensure that the contracts are made in the right spirit, and they're also enforceable. These two things are absolutely critical if we want the industry to succeed or if we want the foreign capital to come into our countries. Now, this is what essentially I started talking about, that is reducing investor cost and increasing their confidence, decreasing risks associated with renewable energy. Now, here, let me just break it down into three buckets, and that's what we have on the slide, which is basically the project start and development. What can we do collectively in this phase? Investment risk management and scaling up investments. So in project startup and development, I think the biggest challenge typically in investors that I have seen face is in terms of availability of land banks and availability of grid connectivity and clearance associated with that. So if and contrary to that, if you have tracked some of the auctions within India, you would have seen that projects which were basically bidded out under something called solar parks, where the government actually buys out the land, develops the transmission facility, and asks investor to just come and plug and play. There we have seen a substantial reduction in tariff, because these two components actually are the biggest risk areas in terms of a project development cycle. They consume the highest bandwidth. They also consume the highest amount of time, which people want to reduce. So long story short, if we want to bring down the risks of project development, especially in our countries, we need to come up with pre-packaged projects. So basically, develop the infrastructure and ask investors to just come in, plug in their capacities, and start supplying to the grid. Investment risk management, I think this more or less we understand in terms of, there are different, and this is specifically important when we are looking to bring in, to attract foreign capital. And I think all of our member nations want to attract foreign capital. We are still either low or middle income nations. So in this case, it is essential, as I was describing before, to have two, three things. One is to have a very, very transparent contract which has the right balance of risks. So you only allow the risks that the investor can bear to pass on to him. For example, if it is about project cost, which is how much, what is the cost of panels, etc., and how much he can buy it for, that's a risk he can manage well. If it's about financing and interest rate, it's a risk that he can handle better. But if it is a risk of exchange rate, for example, that's a risk he may not be able to manage better than a public sector. So we need to identify what risk can be managed by the private sector and what risk essentially can be either managed by public sector or it is allowed to pass on to the consumers. So the right balancing of risk in the contract is extremely essential. Second is that there are a lot of international financial institutions which offer guarantees and or some securities, etc., for managing some of the internal countrywide risks. So it is essential that we engage with these multilaterals, and I think most of the governments have done that. And to ensure that such line of facilities are available at a cheaper cost to many of the international investors who are coming into the country. And the third is that if we can create some sort of incentives for people to come in. And when I say incentives, it is, I think the best incentives that I have seen working is not incentives which give people a higher return, but incentives which can actually work to mitigate the risk. So, for example, in Latin America, a very successful program was basically having dollar PPAs. Now, essentially, their situation was slightly different. We may not prefer to have a dollars PPAs because of a volatility of our currency. But just as an example, these were risk mitigation measures which worked well there. can we have a dedicated fund which provides currency hedge at a low cost to international investors coming in? Can we ensure their returns on a dollar to dollar basis are ensured at a minimum level? So some of these small ideas which we can explore and have some public funding towards that, it can have multiplier effect rather than just putting public money to develop an asset. If we create if we use public funds to create securities, it can actually have a multiplier effect in terms of capacity development. And finally, scaling up its investment. I think here it's basically a little more financial issue where we need to ensure that the transaction cost for small, large projects are kept at a minimum. So it helps people who are looking to scale up because renewable energy is attractive only if it is allowed to scale. No company will make money by just putting in one asset. He always wants to grow. So we need to ensure that multiple assets, the transaction costs are lower and lower. So I think this slide I have discussed quite a bit in terms of the constraints and the technical solutions. So I will just um, go through these slides again on the on lending of financial institutions. This I spoke about. And the fifth one is mobilizing international incentives. Now, while we are talking about these incentives are no more available. I think globally, in some manner or the other, we are going through a phase where individual countries are taking up responsibilities for their own development. But it's good to know some of these things. For example, we all know about the CDM mechanism which was there and which my colleague Ankit also described, wherein basically every country had a carbon target. These were given out to the industries, and the industries not meeting these carbon targets had to buy um, CERs or carbon certificates from international markets, and typically this benefited a lot of Indian and Chinese companies who used to be a net exporter of carbon credits. So it essentially helped to bridge expensive technologies, expensive projects in their home country. But this facility is no more available, and I think. But what we essentially could learn from this facility is that a market-based approach, and India somewhat tried to replicate it into this REC market. In some of the large SAARC nations where we have a large number of industries and service sectors, etc., we could look to replicate within our own country level a very similar, a renewable market or a carbon credit market. Um, INDC, which is basically national determined contribution here under the Paris Agreement, all of the countries have have basically mandated a certain amount of carbon reduction. There is certain amount of investments which we feel is necessary, and some of these we have mapped it down. I think there is also a lot of what I mean. Just when we're here, I think there's a lot of effort being made by many of the European investors to invest into renewable energy projects. So and this basically comes as a collaboration where we as a region countries could explore to collaborate with some of these very niche countries with whom traditionally we may not have much dealing, to see that their funds and their sovereign funds and their banks and investors could actually come in and invest into our individual countries. But again, here we need to ensure that when they come and invest, we are having an investment environment and climate which they can find conducive. Point six is cross-border programs, and I think we have discussed this substantially. And when I say cross-border programs, essentially I keep it down to basically three things: a free flow of skills, free flow of technology, and free flow of capital. If you're able to ensure this, then other things will always fall into place. We have made some more granular points, which is about cooperation between government entities. I think this is happening in partial level, but not at the level in which we would see some of the more successful regional pools like the North Pool in Europe, or we have Western African Pool and Eastern African Pool. Even they are, quite vibrant in terms of developing policies, etc., which is more region wide. So I think that level of cooperation in terms of energy trade, etc., is not there in SARC. That's something we could actually look forward for. Cooperation among financial institutions. Now, many of, as I described, I mean, in terms of renewable energy, many of our countries have done things which are different, and some of them we have been successful in very different areas. We have been successful in creating large capacities, but for example, Bangladesh has been very successful in creating small and micro facilities, which is actually very integral if we look at renewable energy development. So it's important that the financial institutions also talk to each other. There's a collaborative effort to bring in capital from elsewhere in the world, and also between the region there is free flow of capital into each other's projects. We should look at cross-border trade of projects. I think there are certain developments in that which SARC SEC has been taking it forward. Maybe a mission-oriented organization at SARC level, and I think an organization already exists, but empowering these organizations to not only work on the advocacy bit, but also to look at some more real development in terms of setting up projects, in terms of collaboration at the financing or the policy level. Some of these initiatives have to be driven by the very top of our national governments to empower this central organization to work with a little more free hand, with a little more execution powers, so that it can be made possible. Now coming back to financing, and again, basically, if we look at depending on the stage at which each country is, the kind of funding or the development models vary. We have, if you look at pure public funding to public and private partnership model to pure private funding. So these are the complete value chain. I'll not speak a lot on this. I think this has been discussed, but if you have any questions around this, I'll be happy to answer that. I think the ultimate objective in this is for countries to migrate from pure public funding mode to pure private funding mode. But that journey doesn't come simple, because and it's going to take time, because I don't think there is any country within SARC which is actually ready to migrate to a pure private market, because the energy market is purely is mostly regulated. So to that extent, it's a gradual progress, but I think countries should aim to move from public to private mode. So this is the last slide of my presentation. I'm very happy to take up any questions on either of the 2-3 topics we have done today. I would be happy to answer that.
Well, thank you very much, Sandeep. Though we are short of time, but I'll be taking 2 quick questions. One is that it's regarding basically Pakistan scenario. It's basically, the question is also from Pakistan, that do you have any understanding that why microfinancing basically not making difference in Pakistan as it did in Bangladesh? So can you elaborate, put some light on this?
Yeah, I think when it comes to microfinance, and I can speak from I'm not too much aware of the Pakistan scenario, but the little bit I know about Bangladesh and their difference with India is, I think microfinance is a lot about execution. How well can we execute the projects defines the success at the microfinance level. Having said that, I think microfinance today is undergoing a transition. There are more innovative financing structures which are available, and I have known that in Bangladesh, some of it has been very successful. There are certain multilateral institutes like Guaranco, etc., who have made some forays there. But I think when it comes to microfinance, it is more about execution, because the challenge when we are doing small bits of, when we have a single large program, right, or single large loan or funding or a project, it is very easy to monitor it, because it's just one position. But when we are looking at fragmented programs or fragmented systems or lending, it is very difficult to monitor and to ensure that the right control is established. We actually have gone through a very similar phase about maybe 7 or 8 years back, where the microfinance were not doing well, and they were not doing well because they were not executing well, because there was a lot of pilferage which was happening at the ground level. Ground level networks. There was lack of monitoring and controls over this, which essentially led to many challenges for the microfinance. But gradually these all improved and we are now at the right stage peaking out. But I think in terms of microfinance, it's all about execution.
Thank you very much, Sandeep. I'll take one more question. It's basically from Nepal, and our friend from Nepal is asking that do you have any idea of how many projects are in place in South Asia on carbon trading, and if you can elaborate about the size of such projects?
Okay, so I do not have an idea on the number of projects because all these projects were mostly before 2014, that which I can say. And after that, the CDM market was closed. But if you look at the size of projects, that I can tell you is that the size of project can range in energy. It can range from anywhere between couple of 100 kilowatts. Sorry, a couple of megawatts, basically 10, 15 megawatt solar projects, to as big as 4,000 megawatt clean coal-based projects as well. So there are certain thermal projects, for example, Sasan is an example, which is about 3,600 megawatt, has also achieved carbon trading certificate. So the size of the project varies substantially. The number, honestly, sir, I'm not aware how many of these projects have been registered.
Okay, though I am short of time, but we have a good number of participation from Afghanistan, and I am
Yeah,
forced to give them the floor for a certain question.
please, sir. Happy to answer.
Yeah. Hello once again. Thank you so much, Mr. Sandeep, for your nice presentation.
Thank
I
you.
would like to ask about the reverse auction systems
Yeah.
and how this works and how the PPA applies in the rest of SAARC countries. Can you elaborate this about the PPA in other countries?
Sure.
Yeah, sorry, Sandeep, may I request the person to introduce himself?
Yeah.
Yeah, please.
Yeah, my name is Rohula Arya and I am the head of bioenergy department in the Ministry of Energy and Water.
Okay, your voice felt differently. I'm sorry. Okay, please, Sandeep.
Yeah. Okay. So if you look at PPA structures, and I'll start with that before moving on to reverse auction, how it works. If you look at PPA, the types of PPA we have had in renewable energy, there are basically three kinds of PPAs that we have. One is a FIT based PPA, which is basically the way it works is that there is a central regulator. The central regulator comes up with a tariff which is market based. So they'll come up with what is the typical project cost, they will come up with what is the typical OPEX cost, the typical life of the project, 25 years. It takes 13 months to develop, what could be the typical interest rate. And so you have 4 rupees, let's say you have 3 cents or 5 cents per kilowatt is the tariff that they will come up, and this becomes a public document, the FIT, basically feed-in tariff. And any investor who believes that he can build a project and supply at 3.5 or whatever is the feed-in tariff, he signs up a PPA with the procurer or the distribution company, the energy retailer in the specific country or the state. So this is typical. This kind of PPA is very simple. It has a link to the FIT which is being declared by the regulatory commission, and it has normal project related information and the normal contract related information like payments, etc., force measure and all. So this is the standard PPA which worked very well during the initial phase of growth. till about 2014, if I can say, in India. The next kind of PPAs are basically small direct consumer PPAs. So in this case, the government doesn't typically have a role. Here, the PPAs are signed on directly with energy consumers. This PPA can again be in two types of tariff. It can be a flat tariff or it can be a discount to the grid tariff, which means that if the grid tariff for the building that I'm sitting in is 5 cents, they can sign up at a 20% discount of that at 4 cents with an energy with a renewable energy player. So this may not be too relevant for policymakers sitting here, but I just wanted to tell that this is another type of PPAs we have seen. And the third type of PPAs, which is more important from a public sector point of view, is competitive bidding PPAs. So essentially, and let's just not talk about the second one, but the first one, in case of first one, because the tariff is being set by an independent authority. In this case, the tariff is a discovery mechanism. And the reverse auction or forward auction are just two ways of auction in which the price discovery can happen. In case of forward auction, what happens is that the government or the public agency just declares that we need X amount of capacity to be delivered at 2 years from now for a period of 25 years, let's say. And people quote whatever tariff they believe it is fit. Now, somebody might quote 3 cents, somebody might quote 10 cents, depending on what he envisages his project cost is. In case of reverse auction, the only tweak is this, that there is a minimum ceiling of tariff which is previously established. So the public agency comes up with a tender which says that the maximum tariff where we start is 5 cents. Now that maximum tariff could either be declared upfront by the public procurement agency, or it can be discovered through a EOI process. So in EOI, you ask investors to quote a number, and whichever is the lowest number, that becomes the ceiling tariff. So it can work either way. That becomes the ceiling tariff. Then investors can log in into an IT system, and they start quoting. So all qualified investors will start quoting prices below 5 cents. So somebody quotes 4. Now that is valid for, let's say when I quote 4, the person sitting next to me with a different company might actually quote 3.9, somebody else quote 3.8. And in this way, the prices come down till somebody comes up with it's like an auction that we see on in auction market where they sell that you wait till the last bid. So whoever's the last bid, the lowest bid, he wins. Now, this is the difference in only price discovery. As far as the PPA is concerned, it's very similar. In PPA, you will just have the auction, which is the auction discovered price, which is put in the PPA. The rest of the conditions are very similar in terms of payment, collection, billing, force measure, change in law, etc. So those PPA conditions remain similar. It's only about how the tariff is discovered might vary in these individual PPAs.
Thank you very much, Sandeep. And here we will end with our question answer session. But I would request that you should stay with us till till the end of this webinar, so that we can have some question relevant to you and you are able to answer. Meanwhile, ladies and gentlemen, I would request that since we have covered most of our break time, so I suggest that we should end up with our last presenter, who is Mr. Amir Zafar Durrani. And I wish that, and I understand that he will be brief to cover his all thoughts in short time. So Mr. Amir Durrani is the president and sole proprietor of Reenergia. It is an energy consultancy and services company focusing on business innovation and diversification in renewable energy services. He is an acknowledged development expert and is presently involved in renewable energy and community driven development. His experience spans over 34 years in 26 countries, of which 18 years long were solely dedicated to World Bank. With this short introduction, I may request Mr. Amir Zafar Durrani to share with us his knowledge and experience regarding financial incentives and mechanism to encourage private sector investment. So over to you, sir.
Well, good afternoon, and early afternoon to people in different parts of the world. But Shweb, can you hear me?
Yeah, please go ahead.
Yes, sir.
Okay, excellent. I hope everyone else can hear me. I'm just trying to establish, can you all see my screen?
Yeah, and rest of the people are also able to
Excellent.
see.
Okay, excellent. So thank you very much. I actually have been online since the last hour and a half, and I found that a lot of what I had actually put into this presentation has been covered very aptly and ably by some who preceded me. So I thought that, and in fact, I found the last presentation to be exceptionally good, and I wanted to commend the presenter on that, the depth in which they've gone into the debt structures on the financing side. So I think it gave me an idea, and in order to shorten my presentation and to be within time, I think I want to start first with about five key elements of what I want to talk about. I mean, the first thing I want to mention before we proceed into the presentation is that we have to understand in the SARC that there is a primary shift happening in how power, not just energy, but power is delivered to people. It's moving globally from a centralized grid model, which is more now considered a 19th, 20th century phenomena, to a distributed model where, and there are multiple reasons for that, and I'm going to quickly list them. Number one is the falling cost of renewables. Number two is the drive for energy security in countries and nations. Number three, it's the sustainability concerns. Number four, it's environmental considerations. Number five, it's the oversubscription. And I think the two presenters before this mentioned this oversubscription of the captive grid offtake, which has resulted in substantial power sector debts accruing all the way, not just in our region, but even as far and in countries like South Africa, if you read Eskom's debt currently. And last but not least, obviously, it's the desire that by 2030, we all have to meet SDG number 7. So having said that, the second point I think we need to understand is that while we are still advocating in the SARC for public policies, the world is switching more to private consensus. And let me give you an example of that very quickly. The example is of the Renewable Energy Buyers Association in the US of A. So despite the fact that the US government appears to be bucking on its promises to the environment, if you actually drill down to what's happening in the US society, you will find that they're actually doing better at adopting sustainable and clean energy mechanisms than the rest of the world. Number three, institutions. We have a tendency to create more and more and more public sector institutions. My question is eventually, do we really need them? Because what we see in the world is more private sector activist associations that are making a bigger change in how adoption of new practices happens. And the last thing is that, I have always, and I think some of you who have had the chance to look at what I have helped, Shoaib Saab has, I've supported him. It's been more that in SARC, we focus now more from those who are already being served to those who are unserved and underserved. So with that, I proceed. And please, I'll be open for questions. I'll try and do this quickly. I think most of you have already been briefed on the renewable energy market. And I think that here we are basically looking at, the key types are grid offtake, distributed, and then obviously we are looking for, and within the distributed, obviously there has been this debate about AC and DC. I think we all know this. On the types of financing, just give me a second. I'm trying to get rid of the screen bar here. No, I don't want to do that. Sorry. Yeah, I think that's what I wanted to do. Okay, so in terms of types of financing renewable energy, I saw at least in the last 2 hours that there has been a lot of coverage. People have talked about equity finance, project capital, debt finance, off-balance sheet, project-based financing, and obviously there was discussion on corporate finance. So I think that you all have been sort of lectured enough since the morning. So let me go and I'll go through these slides a little quicker. I think this slide serves, so my next point, that given that we have these types of financial instruments, one thing I think, and just to summarize what you heard in the last two presentations, is that with an increasing level of risk, you need the private sector. With an increasing level of leveraging, you can actually work with the private sector and the private. And also, again, on the same time, we can see that financial instruments vary depending on whether you're just looking at financing barriers, are you looking at both barriers and non-finance risks, or if you're looking at project risks. And again, I am not going to repeat this because these are in all the slides you've been hearing since the morning. I think they lectured a lot well on, equity, senior debt, amortization, how liquid guarantees work. So I think that moving forward, another thing, it's again taken as a summary of what we heard in the morning, but I think this is a good summary to remember. So essentially, one thing, and I think the presenter in the last presenter mentioned this, that as you go down from, let's say, venture capital to things like bank senior debt, and then what I have not mentioned on this slide is the public sector, the level of risk reduces. And as you can see in the line below, as the level of risk reduces, the returns expected also reduce. So what this means in simple terms is that the more innovative the financing mechanism that you pick from the market that is trying to address something riskier, the higher the return and therefore the higher the net cost to be taken. I think the example given by the last presenter on the UAE, especially on the bidding, is actually very, very appropriate, because nobody yet has seen what bidding will do in countries like SAARC, where we are very weak in keeping and sticking to our agreements and our policies. So actually, while in countries like the Gulf and in Morocco, they may manage to be the first payouts, it's going to be very difficult for Pakistan or for the SAARC region in general. So now, again, I just always want to make sure that, if you talk of grid offtake projects, again, summarizing, there are still, and I think you've heard about this, three types of grid offtake. You have the traditional offtaker, you have the other common offtakers like power markets, and then you have things like corporate purchase agreements, or you may have, so basically these are the three. So traditional offtake, power markets created by a pooling of off-takers, and you have corporate purchases. And I'll give you some examples of this in the next slides. Off-take structures, you have traditional power purchase agreements, synthetic. I think we haven't talked about synthetic, so I'll spend time on that, but you've talked about hedging, and I think we've also talked about other structures and trends. But I think this is an important thing to understand. This is where I think some innovation is happening in the world, and I did not hear a lot of this mentioned. But if you look at it, what is realistically happening is that, and I'll try to spend a few minutes on the concept behind renewable energy buying, is basically, as you know, that mostly in our countries, when you implement a large renewable energy offtake, or you do standard fossil-based energy, you actually then say, okay, I'm going to buy energy from that. So the energy that comes to your house or to your factory is a mix of many things. It's a mix of hydel, depending on whatever your energy mix is in your power sector in your country. However, so how can I say, and this demand has arisen, for example, because there are now regulations saying that if I'm going to run a data center, for example, if I'm Amazon Web Amazon Web Services, so I need to have clean energy driving. So there are certain regulations monitoring that. So how can Amazon a data center show when it's actually plugged into a supplier, which is the local utility, that it's running on clean energy? I think it's going to be difficult, other than it going off grid, which is very expensive. So what is happening more and more in the last 5, 6, 7 years is that off-takers are basically doing deals directly with, or have become what we can call through agents between the producer and the consumer. And the consumer in this case can be the large organizations that need to show that they're really using clean energy. The second thing there is that as clean energy costs have fallen down, a lot of this energy contracts or power contracts can be very symmetrical, which means that they can actually be more predictable. In other words, we know that solar is going to cost 4. It's not a commoditized entity, so it's not on the stock exchange. So as opposed to fossil fuels, price variance will not happen. So it's also, a producer of choice. And to enable this, and this is, I think, one of the areas which are not we are weak in the SAARC countries. How do you actually create these? So while we have producer associations, we do not have consumer associations. So I think that's one thing I wanted to spend a few minutes on. Again, I'm going to skip these slides because I think you will get these. I've talked about these before, but I'll take you to, because we have talked about green bonds, how they're being investment. So after listening to the previous people, I think that there is no need. But I want to talk a little bit about the global off-grid renewable energy projects, because to me, as I said, one of the challenges, and why do I consider it a challenge? I think I've been now 3-4 years talking about this, that of the 1 billion unserved people on the planet, 300 plus million of those are in the region where we are. And actually, we need to be very cognizant of the fact that this is really, if we are to meet and make sure that everybody has energy access, this is really the challenge that we need to talk about as a regional challenge. So within the global off-grid renewable energy, I'm going to talk about, and this is a study that we've just recently completed. So I thought it might be useful since Shoaib and Marwat had asked me to talk at this. Give you a little flavor. This is going to be a world, region, and then specific example of Pakistan for people in the region to learn from and maybe give advice on. Basically, if you look around the world on distributed generation, there are 3 models or business models. Obviously, one private sector, donor government funded, and the sector with so it's kind of a public-private, and then the simple government-led projects. Globally, we see that there are very few private sector-led projects, complete private sector. And of course, there are examples in our region and in Africa. And again, you can see from this provision is that really these are the unserved markets. That's why you see people making an effort. I think the people in Bangladesh are familiar with this, and I will not spend time. But just to give you an example, that there are very few purely private sector-led DG projects, and they're also being pioneered mostly in our region and in Africa. If you look at PPP in the same, obviously there are a lot bigger examples. There was a question in the previous presentation, I think, from Pakistan about why microfinance doesn't work and why it's working in Bangladesh. There are many reasons to that, and maybe I'll handle that during the question answer session. Then if you look at government-led provisions, these are mostly concentrated, unfortunately, on just solar home system provisions, not on distributed generation, by which I mean proper grid-based supply and grid quality access to energy. So I will quickly now want to run into the discussion on the case study, and I think this will be really exciting for the audience because this is something very new. So we've basically done some learnings and surveys which we completed last year. It essentially covers both the north and the south of Pakistan. And just for all of you in the other countries, the difference is the north has more water resources, so a lot of hydro, etc., as opposed to the south where we have a lot more wind and sun. So therefore, we did a sampling of villages. Now, the basic components that we used, and it become clear from the study, is just like in the grid-based models, the mini-grid models is also about demand management, quality of the service you supply, revenue, how it is collected, like at the utility level, end user finance, who finances, this is where microfinance comes in, and how you design the tariff. But one thing which is unique to mini-grid promotion, and if you want to go into providing power to areas, and I think these are examples which are very apt for, let's say, Bhutan, Nepal, Afghanistan, parts of Pakistan, and who knows, parts of India. My familiarity with some parts of India is not that great, but this definitely I know works, also applies well to Sri Lanka. I think that it's the promoting income generating end users. So we'll talk a little bit about this, but essentially one of the things, and you can see, and I think it's important to understand that in working on distributed generation, you also need to make sure that for these things to be sustainable, the power that you give to the unserved or the underserved ends up being utilized in more productive uses. So given that this is a short presentation, I'll not spend time, but please keep this in mind. Maybe we can take this in the questions. So basically what we have done for Pakistan, based on the global learning that we did in the study and also regional, we have basically formulated certain business models which are based on who finances, how do you finance, what's the business model, what's the design, is it a mini grid, is it a solar home system, is it central grid connectivity. So actually we have weighed in this modeling central grid versus off grid. We've also looked at how operation and maintenance happens. Does it happen through the private agency? We're also looking at village scenarios as if, how is the village organized? Is there a community organization? Do they have the ability to run or not, or will they be needing some technical assistance? We then also looked at villages which can be in, we basically thought for this region, especially for Pakistan, you have four types of things. You have low income densely populated clusters, you have relatively high income densely. And so this is about sparsity of clustering of population because this impacts the design. For the village scenarios, we looked at economic status, we looked at how dense they were, and again, whether they were clustered or not. Remember, clustering is important to understand because 700 meters or more on traditional 11 kV, you start getting losses. So we tried to model scenarios where we kept losses to almost zero. And so there's a lot of work that went into the study, but in essence, what we did is we plotted the likelihood of success. So if you go to the right side of the x-axis, you can see how successful these kind of schemes have been, or have the chance of being, based on global, regional, and country learning. And on the y-axis, you have availability of the model. In other words, is this model currently available? So for example, the closer you are to the left bottom corner, that means these models are less available at this point. So as you can see on the left top, the grid is available, so all the grid goes there. But essentially what you have here is the models that are in that corner up in the right hand top are the ones that simply are the better ones to adopt. And again, I will go into the question of what is, but essentially the model that works out good for, and let me take you back, is the model where you have the distributed generation, clustered synthetic utilities with community and technical service providers. So that was the result of the study. But in essence, the overall learning that we have, and in terms of how to finance, how to develop, is that number one, there's a dire need to develop an off-grid electrification policy. And I think the speaker before the last speaker mentioned this, that we really do not have kind of how to scale off-grid electrification or even on-grid unsupplied electrification. So there's a dire need to have some understanding. And I mean, I'm going to replace policy in the next with understanding. The other important thing is that models being developed so most of the people who are trying to hit this unserved sector are using finance, microfinance. I didn't show you the slides, but in Pakistan specifically, and maybe this answers the question from the Pakistan, and that, the people which the cost of a unit, a kilowatt hour, for a poor that you use or you serve, and you provide basically a solar home solution, which essentially provides a fan, charging, and a light, is 48 cents. That is exorbitant. So we need to be very careful that we are not really I mean, in other words, the poor end up paying for the poor, and this is really something that we are now having a lot of discussion in Pakistan about, and hopefully we will have some further movement. But microfinance models need to be revised, because currently the way they finance, the poor end up paying a high cost for what is not even quality energy access, right? Because they cannot use inductive load, they cannot really change the quality of their life. So basically, this is just about the 20th century concept of light for security and maybe a fan and the poor. And we've seen, when we've done a lot of studies, that essentially providing a light and fan has no basic impact on real quality of life and economic improvement in the life of poor. It's kind of neutral if you look at proper studies. The third thing is the rural electrification models need to learn from this, and you need to make sure that instead of paying the higher, so in other words, if you, instead of 48 or 45 cents, which is what they are getting under the solar home schemes through microfinance, even at half of that, which will be still quite high, because technically, if you ask any of the SAARC governments, they'd like to provide electricity to the poor at between 1 to 2 cents, because they believe that up to 50 units or 50 kilowatt hours, this is what they would like to keep it at. But that has to change. But at the same time, we need to have some modeling done, and which we have, by the way, in the study. We've done IRRs and FIRRs on financial rates of returns on what model provides what kind of sustainability. I think that we will have to come up with some new approaches on this. The last thing is for Pakistan specifically. The current models in rural off-grid electricity in Pakistan are missing a critical partner, and so that is also a good case study for both Bangladesh and parts of India, where communities are directly being kind of experimented with grants, and they are provided systems and local grids, and they are expected to manage them and sustain them. So one of the learnings we've had over the 5 years of implementation of the projects that we reviewed is that you still need a technical partner of some sort. So we see, as we go forward, that a lot of technical partnerships are needed in these off-grid. So all those entities like Siemens and the others need to move into the sub 5 megawatt space. I think the last slide, how do we get electricity markets to increase power sector involvement? And I think this is kind of nice to summary after all the slides that we heard. You really have to, in broader terms, and I think everyone said this, improve the risk appetite in the local financial markets. I mean, I heard mention that India's markets are not that deep, especially insurance. Well, I think that is still better than the condition in most of the other SAARC countries. So I think this is an important area to focus on. And hedging risk, and the last presenter said that we just don't have the supply chains to start manufacturing locally for some of the renewable implementation. I think that we still have to make a start, and that is really how we're going to bring in sustainability. And the third thing is that you cannot have a broad brush approach, and I think India is a good demonstration on this, that we need bespoke financial solutions for each demography and locality. I think offtake guarantees and capacity payments at the grid level need to be really cut down, and the previous agreements renegotiated for the new systems to come in, because otherwise most of the public capital is being sucked up by paying these capacity payments and debt payments that have been guaranteed, offtake guarantees have been taken. How that is to be done, there are multiple approaches, but I mean, unless we do that, there's a problem more concerning Pakistan, and maybe parts of India is now witnessing that, but I think that this needs to be gone. And I think that when you go into distributed-led markets define tariff, rather, the only thing we should be into is regulating quality. And I think, and I'm sorry, the last slide, this is not REBA, it's REBA. I think, and as I mentioned on one of my previous slides, that we need now consumer pooling and consumer power, this consumer pooled power to power, what by power I mean market power, to actually start negotiating directly with producers and wheelers. So I think that's about it. Thank you very much.
Thank you very much, Mr. Amir Durrani. for a focused but brief presentation, and of course, the special presentation skills you have. I'm really grateful for your time and joining us in this webinar. Of course, we have questions. Whether would you like to start with that Pakistan question, that why microfinancing not making difference in Pakistan as it did in Bangladesh? So then I will move to next questions.
Yes, Shabsam. So essentially, I think that my answer was in my slide, and I mean, whoever asked that, we can sit. But the bottom line is, in rupee terms, at 10% rate of interest, which is the lowest band that the microfinance institutions are offering, other than Akhuwat, the cost per unit for a solar home system, that if you calculate, is 48 Pakistani rupees per unit. So as you can see, it's just enormous. The other thing is that in Bangladesh, the World Bank launched a very large project called IDCOL, and basically Grameen, BRAC, and a lot of other agencies went through this facility, and at one point in time, I think it were 15,000 houses being solarized. But please understand that when we say solarized, these were just what do you call one fan, two light bulbs, and some charging capacity. And the problem there, and I think Bangladesh is going to start feeling that now, is that Bangladesh went and did this at scale. So yes, it was the right thing to do in 1995 till 2015, based on 20th century. But because these households that took up this could not do behind the meter grid, in other words, they were not linked together. When they start looking for refrigeration, when they start looking for higher quality of life for commercial users, a sawmill, running a salon, it's not going to work. So I think that while we may think it worked in Bangladesh, I think that my answer to the Pakistani person who asked this question is that, to be very honest, it is not working in Bangladesh. They will have problems. So I think in a way we are doing fine, because we are very early on realizing that the microfinance market needs to come up with a better products to serve. And this single solar home solution, pay as you go, it's becoming a financial manipulation, and it's really hurting the poor. So in a way, I'm kind of glad it's not working in Pakistan, because otherwise we'll be really cheating the poor.
Thank you very much. Thank you very much for rebriefing. And another question is that what is the size of market in comparison with the traditional corporate power purchase markets?
Oh, that's a very good thing. So, let me just put this in perspective. So, if we put, so Pakistan has, and I'm going to give you an answer for Pakistan only, because that's what we have a grasp on. So in Pakistan, this market, if valued, and there are three variables we use in this valuation. Number one, the Pakistani consumer, if you agree with NEPRA's, is consuming somewhere between 450 to 500 units per person per year. Secondly, the size of this underserved market is, according to the government, 55 million, but according to us, it's 80. But even if we take 55 and you do the multiplication and math, this market is about 4.8 billion US dollars, right? So 4.8 billion US dollars. And let me give you an additional agree on that, is that when you, and if you're looking at gigawatt hours, I'm sorry, I don't remember the exact number, but it is like said it's huge number, right? Because even at a utilization of 450 units per person per year, which is 1/10 of the global average, we have the size of this market. And the important thing is that currently there's another study that was done and completed by World Bank, also published by SMAP, that Pakistan's poor spend per year something close to 2.3 billion US dollars on kerosene and candles alone. So this is a market that is not only existing, but there's also a capacity to pay should we start provision.
sir. We have another question that is that are venture capital funds in operation or in use in SARC member states? Do you have any idea?
I actually, I can't tell you about India. So maybe if the gentleman who was here before me, maybe he can give you some answer on that. But definitely not in Pakistan, not in Afghanistan, definitely not in Sri Lanka, definitely not in Bhutan, definitely not in Nepal. So I can by safely you can say that in the power sector, no. I mean, unless there is some example in Bangladesh and in India that I don't know about.
Right, sir. We'll ask the same question in the end from our colleague Sandeep Kumar. The last question is that I mean, can you elaborate the? I mean, it's a colleague from Nepal. I may not be able myself, but since you have this presentation, his question maybe you can understand his question. He's asking that the mapping you have done on BCG metrics for showing slides.
Yeah. Go ahead.
Yeah, that's what he wanted to know, that whether the mapping is done on BCG metrics.
The answer is yes. The mapping is done on a Boston Consulting Group matrix. Yes, correct.
Yeah, fine. So, sir, with this, we end up with this question and answer session. I may request if Sandeep is here, he can answer that question, and with that, we will be conclude our session. Yeah, Sandeep, please go ahead. Sandeep, are you with us? Okay. Sandeep, you have actually yourself unmuted, muted yourself.
Okay.
Please unmute.
Yes, it's done. I hope I'm audible now.
It's working. We can hear you clearly.
Sure. So, just I think a very nice presentation to suggest. The previous one is good to hear. I'll just take up the question on venture capital. So, see, traditionally venture capitals have been, there's a traditional definition of venture capital. In older times, we used to call anybody who is funding a very early stage startup as venture capital, and then once you have built up capacity, then the traditional private equities come into play. If we go by this definition, then there are venture capitals who have funded renewable to start with. We could maybe likes of Yes, maybe the likes of, for example, Goldman Sachs, which invested in one of the largest renewable platform to begin with, then subsequently sold it off to institutional investors, could be classified in that. But in recent times, what we call as venture capital are essentially companies which fund accelerated growth. Now, these venture capital who fund accelerated growth, and where we classify people like Tiger Global, people like SoftBank, people like Sequoia, they have traditionally not invested in pure renewables. And when I say pure renewables, they have not invested in renewable plants per se, but they have invested in other offshoots of renewables. For example, when we talk about electric vehicles, when we talk about small grid connected systems, these kind of investments they have done, where it is where they can actually scale up very rapidly and achieve a multiplier growth, because typically venture investors have an expectations of 10x return, so they will not let you exit below anything below 10x or to their primary investment. And if you think about renewables, or in fact, overall the traditional energy space, that's the kind of return which you typically do not achieve. So that's why the new nomenclature VC funds do not invest in pure renewables, not even in India.
So, I mean, Shoaib, can I just add on to that, please?
Yeah, please.
Yeah, so Sandeep is absolutely right. I mean, and therefore, there are, for example, in the national incubation centers, the 5 that have been set up in Pakistan, and I am quite sure that there must be some investment going into India or in some of the other countries through these accelerators that are accelerating rural off-grid supply. So I know that there are some of these working in Africa, mostly British. So I think so Sandeep has clarified, right? So we're not looking at large scale. So these are people who will exit at taking, as you said, 10x. That's very high, but he's absolutely right. So there are some trials on this going on in Pakistan, and from what I know, also in certain part, but these are not really documented because the size of this is not even let's say even a few $1 million as yet. Thank you.
Yeah, Amirji, actually, you're completely right. There are structures which they call as accelerators, which is actually something which has come up from UK. And but if you look at on the back of it, the people who commit capital into these accelerators are basically DFIs. So these would be funds which is getting committed either by CDC or by a DFID, etc. Not the pure VC kind of investors. So I think you're completely right on that. We do not have pure play VCs in this case, but yeah, accelerator models are coming up very quickly. In fact, I understand that in Nepal also, in many of the social and SME sector, there are accelerators which are coming up, which are backed by UK investors as well.
Yeah, correct. Thank you.
Well, thank you. Mr. Amir, you have another question, which is that what could be the main features of the national off-grid electrification policy? Can you put some light on what could be these features could be?
Yeah, so actually, first and foremost, I apologize because the word policy was written by my associate Zahid, who was helping me prepare these slides. So if it was up to me, I'd say private consensus, because I really don't think we need yet another policy. But I think if you read the current 2019 Alternate Energy Development Board, what we call the new renewable energy policy of Pakistan, it is quite silent on what I think even Sandeep defined earlier. This whole gamut of small provision, but small sustainable provision, distributed provision, and the kind of which is basically going to make the next paradigm shift in terms of making sure that 100% of your citizens in your country are supplied with power. So I think that the first feature there would be a complete deregulation. And I think this is the speaker before Sandeep who also mentioned this, that there is just, currently by law, for example, in Pakistan, you need a license to produce electricity, no matter at what level. Though it's been broken since day one, since we actually put the first, this battery-powered UPS in the country to the generators that most of us in the rich parts of the neighborhoods have in their houses. So I think number one, deregulation would be a good part. Number two, there would be some incentives for the financial sector and those who invest finance in these entities. Number three is that there would be the policy would rapidly encourage sub 5 megawatt production of equipment related to such DG, which is mostly going to be renewables, whether it be wind related, whether it be solar or etc. And the other thing I would do here, and I think which is very important, is that one would actually start discouraging large, more new contracts, large offtakes, because I think they're getting us nowhere other than. These are some. This gentleman, whoever's asked, is welcome to get my email address, and I can have a chat with them, because this is precisely what we are trying to get done in February, March, as long as our client agrees. Thank you.
Thank you very much, sir. And still, we are very thankful that you, knowing that there was a mistake, but you explained it in a lot of detail. And interestingly, the gentleman is in your contact list, so he will himself discuss the matter with yourself. The next point is that we are ending up with these questions, but there is one sort of comment, suggestions from several places, particularly for the study authors. I'll refer directly to Mr. Sandeep. But the reference is for Mr. Raizada that the data which was displayed, mostly people objected that it was not updated at the moment. And since we know that our study was conducted a year back, so we would request that once we are finalizing this study, we should update the data. So this was one comment in general from 2-3 places. So I hope, Mr. Sandeep, you and your team will note it down for incorporation in the report.
Yes, sir, we'll take care of that.
That's great, sir. That's great. So with this, I once again thank you, all of my esteemed presenters, particularly Mr. Raizada, Mr. Amit Durrani, Mr. Sandeep Kumar, and Mr. Antik. So, ladies and gentlemen, we now move towards our conclusion and recommendation part. Since after listening to the experts, it can be easily assessed that this is such a vast subject and highly important that needs more focus upon. Uh, at this point of time, based on the discussion and obviously the conclusion drawn by our authors, it can be concluded that finance is essential part for renewable energy technology projects in two ways. Firstly, without proper financing, renewable energy projects will not materialize. Secondly, with inadequate financial structure and conditions, the cost of electricity produced from renewable energy technology will increase substantially. Enabling policies, financial structures, and risk mitigation instruments are not sufficient alone to achieve the necessary scale of investment. Hence, access to capital markets to tools like green bonds, InvITs, etc., are becoming increasingly important in this context, as it provides necessary liquidity and long-term finance needed in the sector. In the same context, the recommendation listed out by authors in the report and endorsed by the participants are mainly number one, SAARC nations should design effective public-private partnership mechanisms. Number two, investors should use risk mitigation instruments such as guarantees and insurances, and the government should proactively build instruments. Number three, local financial institutions should encourage to invest in renewable energy projects. Number four, member states should develop renewable energy specific policy and incentives. Number five, decentralized renewable energy solutions should be encouraged. Number six, institutional framework with roles and responsibilities should be developed at SARC level. And number seven, and the last one is that cross-border programs, collaborations, and cooperations should be initiated for development of renewable energy sector. So with this, I may like to conclude our webinar with an announcement that this year SEC has planned multiple webinars on various subjects of your interest. So you are invited to attend those webinars as well. So thank you everyone for attending today's webinar. We had listened to some excellent presentations delivered by our distinguished presenters from member states and other regions around the globe. All the presentations will be available on SARC Energy Center's website very shortly. We would love to hear from you any suggestions and comments for further improvement, plus any suggestion topics of your interest on which you want us to arrange future webinars. We would gladly do that. With me signing out, thank you again for joining us today and looking forward to see you next time. Bye-bye.
Chalo ji, well done.